Influential, power, purpose and perspective recognized. NDTV Profit's editorial force gets industry-wide acclaim. He has been tracking markets for over a decade, spots the trends before they hit the screen, and he is now bringing his
Hello and welcome back to NDTV Profit. You're watching Ask Profit, the afternoon edition. My name is Puneet Zaveri, and over the next half an hour or so, we'll try and solve all your stock-related queries. So if you haven't already, do start sending them on the WhatsApp number that's flashing on the top of the screen. You can also call us, speak to us as well as our guests on those said stock-related queries as well. But as we do, before we move forward, very quick check of how the markets are doing, because while the implied open did indicate a start in the red by almost 100 points, we did recover and come back into the green, and since then have slipped in yet again to almost 23,750 now. So we continue to be under pressure as we go into the last 90 minutes of today's trading session. And when you look at the heat map, that gives you that perspective also. While IT has been continuing to dominate in terms of the gainers for today. So Infosys, Tech Mahindra, HCL Tech and Wipro all up in gains today. TCS surprisingly though is still in the red right now. You're seeing larger red screen across the board. So you're seeing Indigo, which will report results today. So continues to be a key earnings. Eicher Motors, Power Grid, NTPC as well as Max Health are all under pressure right now. And that's when you look at the sectoral heat map also, that will reflect you that similar picture where the Nifty IT is up now 1.6%, 1.7% odd. It was up almost 2.2%, so it has also given up some of those gains, while in terms of the sectors, oil and gas, the infra sector as well as what we are seeing pressure on energy and auto, all down almost 1% and more at this point of time. But the advanced decline ratio, that's the other crucial one that we continue to try, monitor at this point of time, because it's been a day where you had certain results that were moving the markets while a lot more that were under pressure. And you've seen that last couple of hours of the trading session, a stark difference between the two at this point of time. Mid caps, small caps also show you that, where in terms of the broader market performance over this week has been actually in line with the benchmarks, and today as well that picture is quite similar, while the small cap although is in the green for now, a minuscule percentage, but we'll take it with both hands at this point of time. And in terms of the individual movers, yet again, in terms of the BSE 500, you've seen Delta Corp continuing to be under pressure on the back of the ruling, which will for the gaming companies, and that the impact continues to be hampering them is what the Supreme Court ruling says. Bharat Dynamics on results, Praj on results, Avanti Feeds on results, all down in trade today as well. While Relaxo is up, so is IFB Industries, and Thermax probably taking some positivity out of Cummins and the results for the company as well. Clean Science also up 6.5%, and HFCL just continues to be in its own realm. So is what we've seen on Sterlite Tech as well. But let me welcome in our guest for the show who will solve all your stock-related queries. Ruchir Jain, Vice President Equity Technical Wealth Management at Motilal Oswal Financial Services, and Radharaman Agarwal, Managing Director and CEO of Swom Advisors. Gentlemen, both of you, as always, thanks so much for joining in. Let me go across and start taking the first question, which is on Tata Motors PV. Has been an active stock over the last couple of weeks, post results as well. And Shankar is holding shares at 401. Wants to know if he should continue holding this counter, or since he's in break even, should sell out at this point of time. Radharaman, very good afternoon to you. What would you recommend?
Thank you for having me here. I think there's a lot of traction coming in the EVs, and especially with this petrol hike happening, and expected the prices might still go up. So I think there's a lot of positive movement towards the PV, and I think you should hold on the stock currently.
Let's go across and take our first caller for today then. This is Murli, who's joining in for a stock query. Murli, very good afternoon to you. Welcome to the show. What's your query?
Yeah, very good afternoon. I am having JSW Infra shares, about 100 shares at an average of 202.
Okay.
I just wanted to know what is the short-term or a year target. Would it reach the 52-week high shortly?
Okay, got that view. So you want a short-term view on JSW Infra. Ruchit, very good afternoon to you. Welcome to the show. He's bought it actually at quite an attractive price, right? Would you recommend him to continue holding, or is it a good time to take money off the table?
Yeah, hi, very good afternoon. Well, if you look at the short-term chart since last 3 months, the stock prices have been consolidating in a range where 295, 300 has been acting as a resistance and 250 has become a support. So overall, it seems that it could continue this time-wise correction in the near term. A breakout above 300 is required for a directional uptrend towards 340. But since the downside seems to be limited from here on, I would advise to continue to hold on the stock with some more patience over there. And once we get a breakout above 300, then you can expect levels around 340, 345 where profit booking can be done.
Got that view. And before we take some of the more stock-related queries, the big number for today, Asian Paints has come out with its earnings. Revenue is at 9,247 crores. We'll, of course, get you that first cut as Sharad will join in very soon. And you've already seen the stock coming back into the green. So was patiently waiting by for those results. The estimate were of 8,781 crores. But in terms of at least versus the estimate, it seems to be a good set of numbers, at least on the revenue. In terms of profits also at 1,172 crores versus estimates of 1,055 crores also looks at a decent picture for the company. Now, it's an important quarter for the paint makers because we've seen Berger also come out with decent set of earnings. For Asian Paints also, of course, we will track the EBITDA margins, but also the volume picture for the company in Q4 as well. So all those details, and we'll get you the first cut right away as well. But in terms of at least these two numbers, the couple of and the stock also turning into green looks decent at this point of time. But let me go across to Sharad now, joining us to give us the first cut. Sharad, what are you picking up?
Well, interestingly, the numbers, two important things are coming out from these numbers. The initial first cut is the PAT numbers. That has beat the street estimates also. And if you look at the number, that's at 1172 odd crore rupees. Compare that with the estimate of 1055 crore rupees. Also, the volume growth number, that is also, we could see that's also doing well. The volume growth came at 10%. That's on the higher band of the expected guidance, which was between 8 to 10%. So definitely the street might like the volume growth going ahead. But of course, the concern remains is the rising crude prices and the crude derivatives. Will that affect the outlook going ahead in the next quarter? That's something to watch out for. But as of now, the volume growth has beat estimates. The overall PAT numbers, if you look at it, that has beat street estimates. And the revenue largely, that has also done well. It's around 9,247 crore rupees. Compare that with an estimation of almost 8,800 crore rupees. So initially, the first cut, the numbers beats estimates, largely in line to good numbers. And if you look at the volume numbers also, that's also on the higher side of the band of the guidance which was expected in the street. So net, first cut seems good, but of course we'll be looking at the internals also and the management commentary as well.
Got the view, Sharad, and thanks so much for joining in. The EBITDA numbers also, looks very promising at 19.3%. The number is quite positive at this point of time, and of course, gives you that perspective of the outperformance for Asian in this quarter as well. But overall, you're continuing to see the stock continuing to be in the green, and of course, we'll get you more updates on this. There was an exceptional item though in the same quarter last year. So in Q4 of FY25, you had 124 crore impact in the same quarter last year. So hence you'll see that bigger number in terms of profits, which we are mentioning as well. But in this quarter, we are not seeing any exceptional item as well. So that's another key concern. And as Sharad highlighted, the raw material prices, the crude oil commentary continues to be very important for Asian Paints in this quarter. You've seen input cost prices also hamper across a bunch of industries as well. But on Asian, that will be the other aspect to watch out for. On revenue growth, this has been a decent picture. Stock continues to be in the green at this point of time as well. When you also look at the employee expenses, not increased too materially, but 100 crore impact, 720 crores versus 631. And in terms of what we've seen in the cost of material consumed, not too big of a jump as well at 3,984 versus 3892 as well. So a couple of these numbers continues to be in focus at this point of time. And of course, you've seen the income, of course, for the owners, seeing a bigger jump versus on a YY basis. So you've seen the owners of the company have got 1172 versus 692 crores in the same time last year. So we told you about that 182 crore impact as well. And just very important that we address these numbers and get you that perspective also. Radharaman, just if I can, because the numbers have just come in, and I'm sure that you still have to look at them. But on the face of it, just these couple of 2 to 3 key parameters and numbers that we put out. Any read that you have on Asian Paints right now?
So the number looks very encouraging and positive. So effectively, look at both the top line and bottom line have grown significantly, and the number seems very positive. In fact, the backdrop is also pretty strong. And the other important aspect is, if you look at from the market, channels have suggested us they have taken a good price hike in the month of April and maybe May as well. So I think they will be able to impact the margin and positively look at in terms of they have taken a very good hike, and maybe with that hikes they will be able to steer to the margins. If you look at the EBITDA margins, what got reflected, they are quite strong. So I think a very strong set of numbers. Obviously, we need to deep dive into details and figure it out. But the initial take is very, very positive on the counter.
Got it. And, we are also being joined by Mayuresh Joshi, the Head of Research at MarketSpeed India. Mayuresh, always a pleasure. Thanks so much for joining in. The numbers look decent at this point of time. And, because, one of the major numbers that we're tracking is the volume growth. So the decorative business for India has shown a volume growth of 12.4%, while a value growth has been of 10.2%. What do you make of these two parameters at this point of time?
Afternoon, Puri. Pleasure to be here. No, I think the decorative volume growth number is definitely better than what the street was probably expecting or estimating as well. And therefore, on the decorative volume number, I think it's a good beat in terms of estimates. When it comes to the value growth in terms of absolute numbers, I think it's a decent set as well. So I think both these parameters, as far as Q4 are concerned, is better than what the street was probably expecting.
Also, Mayuresh, what we've seen is, and this has been across the paint sector, of course, that the value growth continues to be lower because of the lower priced items, getting the primers amongst others, getting much more higher sales. So the volume growth picture, of course, looks good, but not translating into volumes, not translating into value at this point of time. But I think a double-digit value growth bodes well, at least for now. Would that be a correct assessment? Would you agree with that?
Yes, I think that assessment would be correct. As well as the question on the product mix part, I think the lower margin products are obviously getting pushed more into the market as we speak. And let's not forget the competition intensity still persists. Therefore, to a large extent, even on the higher value paint or even the distempers, we're probably seeing large part of competition intensity pressure in terms of pricing still getting played out. But a double digit or a 10% value growth is decent. But again, Puneet, it will be very, very interesting to know and point out what the management feels in terms of all the challenges that we have in front of us on how Q1 and the first half is probably going to play out.
Got it. And also, Mayuresh, because there's been almost a 200 basis point increase in the EBITDA margins. Now, we spoke about how the fag end of Q4 was impacted because of the Middle East crisis, and hence you wouldn't see fully an impact. But even at these 200 basis points growth in EBITDA in such a quarter, because there was some impact at least, do you think what could have led to that according to you?
No, so I think the belief here would be that competition intensity pressures should start petering out. I think the kind of intensity we saw a few quarters back, that should probably not persist in a more intense fashion as we speak. The second element, obviously, is also the expectation in terms of organized market shares actually starting to gain from the unorganized players as we head into a more challenging quartile as far as Q1 and Q2 is concerned. And therefore, I think leadership stocks like Asian Paints and others can probably hold the market longer and sustain in a more robust fashion compared to the unorganized players, both in terms of pricing and managing the dealers and distributors. And third, in terms of passing on the costs entirely, I think the management will be a little circumspect right now because, again, the El Nino effect is expected to play out, which can also play out front in terms of how demand dynamics play out. So how much of a cost push through will happen in terms of end product prices. It's something to be seen, and how much do they absorb in the end. So I think it looks fairly balanced on all these parameters, honestly, if you ask.
Got it. Thanks so much, Mayuresh. Appreciate your time and your detailed analysis also in such a quick, short notice. Appreciate your time here at NDTV Profit. But there you go. That's, the first cut of Asian Paints. Looks like a good set of numbers. Stocks reacting also in green. And as Mayuresh highlighted, there are multiple key aspects to watch from the management conversation also. But a 12% volume growth, 10% value growth will be something that the street will be happy at this point of time. But let's get back to your stock related queries as well. And next one that's coming in is from Bindu from Hyderabad. She's been asking a question on NetWeb Technologies and asking what she should do with this particular counter. Bought at 4,000 rupees per share. Stocks up 13% today and flying. Radharaman, we've seen the broader IT pack perform well, and for NetWeb Tech, a lot of the valuations are of course pricey, but would you recommend her to continue holding or book out taking this 13% move today?
She should continue holding the stock. The positive of the stock is high, and in spite of volatility, I think long-term view remains intact. So she should continue holding it.
Got it. The next one also coming in on Aditya Birla Fashion and Retail. A viewer wants to actually make an entry into the stock now for the long term. Radharaman, sticking with you, would you recommend that? The results were slightly iffy in Q4. What's your read?
My suggestion is not to get into this particular stock. I think company has been consistently not been delivering. If I look at in the past also, they have completely failed in most of the parameters. So my recommendation would not be to get into this stock. There are other good quality stocks available in this space.
Got it. The next one is from Raghavendra Kumar from Bengaluru, asking about Nuvoco Vistas. He's been holding shares at 351 and holding 800 of them at this point of time. Now, Ruchit, what would you recommend him to do? Because stock's up 5% today and come back to his buying price. Does that momentum continue?
I think you should continue to hold on, because after a long period of time, the stock has given a breakout above its 200 DMA today. And that too has been supported by good volume since morning. So, the stock, if it shows a follow-up move next week, which will be important, the stock has potential to rally high towards 390, 400 kind of levels, where you can take a review again.
Got that view. But another question on JSW Energy, Ruchit, this one's coming your way. Balaji from Chennai is holding 100 shares at 615 and asking if he should continue to hold for the short to medium term and a target that you're looking at. What's your perspective?
So 570 is a good support, so that should be used as a stop loss for first on your existing long positions. And on the higher side, if you look at historical data, then resistance would be seen around 640 rupees. So you can expect levels around 635, 640.
Got that view. But let's go across and start now the rapid fire round in this edition of the show. Ruchit as well as Radharaman, you know the drill. First one's coming on Prince Pipe. Satyan wants to know if it's a good time to enter the stock now. Radharaman, what would you recommend? Has been a rank underperformer, but Q4 was decent.
I think you should add.
You should add. Got it. Next one is on Shivalik Biometals. Ruchit, Neha from Bengaluru wants to know short-term view. She's bought shares at 540.
Should continue to hold.
Next one that's coming in now. It's on BSC. A viewer wants to know if he should continue to hold these shares at this point of time. Ruchit, what do the charts suggest?
Book partial profits. Things are overbought, and for rest on positions, keep stop loss below 3,800.
Got it. The next question coming in now, staying with you on TVS Motors. Prashant from Bengaluru wants to enter this stock now. Is this a good time?
Wait for some dip towards 3,300, 3,350.
Okay. The next question coming in now, and this one is on Omnitech Engineering. Ruchit, I don't know if you track this counter. It's something that we've not discussed on the show for a while. But our viewer, Mr. Rao, wants to enter the stock now. Would you recommend that?
A bounce up dip towards 470, 480 range.
Got it. Stocks up, flying and almost 18% right now. Next one's on Jamna Auto. Our viewer Karthik holds 1,500 shares at 131. Results were decent today. Radharaman, would you recommend him to continue holding? It's back to his buying price. The next one's coming in on Asian Paints. I think Sriram, we've discussed this stock quite a bit right now. So hopefully that answers your question. Next one's coming in from Jatin from Chandigarh on Rallis India. He's holding shares at 275, Ruchit. Should he continue to hold his 75 shares?
Exit on any pullback moves.
Transrail bought at 495. Radharaman, is this stock on your radar? Because it's seen a massive correction also in terms of price as well as time over the last few months. Any view?
Yeah, we should not get into the stock right now.
Next one is a query that we're getting a lot today on Siemens Energy. Seems to have run up a lot is what Kunal from Chennai is asking, and he's asking if he should exit this counter now. Radharaman?
We should hold on. I think the momentum is quite strong.
Thomas wants to know about Ashoka Buildcon. He bought shares at 172 last year. So it's been a tough year for Thomas with this counter. Should he continue to hold? Radharaman, it's at 123 now. And if yes, should he average also?
No, he should exit this stock.
The next one coming in now, it's from our viewer Pradeep from Bangalore on Gokul Agro Resources. Again, a very small counter, Ruchit. I don't know if you track it, but he's bought shares at 40 rupees. Any view?
Can hold on at current levels, but keep stop loss below 200.
Also, Ruchit, on MTAR Tech, Gopinath from Nellore is holding shares at 1991. So, almost a 4x right now. Should she just take the money off the table, be happy with the profits?
Can book partial profits only, but continue to hold some positions.
And any targets, Ruchit, that you're watching out for on MTAR?
I think trailing stop loss would be a good method. The support is around 7,400, so that should be a stop loss.
Got it. Well, that was the end of the rapid fire as well as this edition of Ask Profit, of course, with the big earnings of Asian Paints coming in. But Ruchit, Radharaman, always a pleasure. Thanks so much for joining in with your inputs. But viewers, stay tuned. India Market Close comes up next, and thanks so much for watching.
Investments in specialized investment fund involves relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all investment strategy related documents carefully before making the investment decision.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit.
And the award goes to
Tamanna Inamdar. Managing Editor, NDTV Profit.
Leading the newsroom. Shaping the narrative. From stories to impact. A voice that matters. Tamanna Inamdar, among India's most influential.
Welcome. You're watching India Market Close, and it's not looking like a great Friday, I must say. 156 points down on the Nifty. In hindsight, Alex, I think that implied open was indicating what the market mood was, though it's gone through its turbulence through the day. Just pull up the intraday chart for the Nifty, and you will see where that range bound but eventually negative trade has come off to low point of the day, isn't it?
It is certainly, and there are a few heavyweights that are pulling the benchmark lower, but it must also be said that the heat map has turned towards the reds. So whereas this morning it was a pretty even spread, at this juncture just about 10 stocks or so in the green, less than that, and Eicher Motors, Indigo, Power Grid, and a few heavyweights as well. HDFC Bank with cuts of about 0.75%, proving to be a bit of a drag. Reliance Industries also somewhere in the bottom half. There you go, 1.6% lower, proving to be a drag.
Yeah, it's just pretty much all the IT majors which have held on, including Infosys, Tech Mahindra, Wipro, HCL Tech. And this is a consistent pattern. On the days that IT does well, everything else suffers. Pull up the India VIX if you can, because that's an important one to mark as we go into the closing trade. This climb is not good. This is not good news. Not very clear what is bothering markets to this extent. We'll get you the Brent also in just a second, but let's get to your broader markets before we do that and see what's happening with the mid cap and the small cap, also all towards the low points of the day. Let's pull up the small cap index and you see a similar picture. The sectoral heat map, Alex, also tells you that the breadth is clearly turned negative in most sectors in the red.
Absolutely. IT, as you pointed out, is the one bright spot. Realty is the other one, but 0.4%, not too much to speak of really. Oil and gas, it's largely on account of Reliance Industries, and consumer durables about 1% lower. But really, I think, Tamanna, today it's individual stocks. We just saw FACT, in fact, it's on the screen right now. It's a fertilizer company. I don't know if there was a one-off, but the number on the PAT is very low at this point, just about in the profit. 3 crore is the number, and the stock is dropped very substantially. This is just one of many stocks that is reacting to numbers.
Margins have more than halved.
Yeah, so there you go, 95% drop in net profit, coming at 3.2 crore rupees. So clearly, on the earnings front today, there seems to be a little bit of a worry. Maybe it's just a bad day, but several stocks have come through.
I think that, and if another factor that if I had to pinpoint, Alex, would be what IMD is saying about the monsoon forecast. Yeah. That's now a real problem that we can see in front of us, because the IMD is actually reduced its number for the amount of monsoon that you will see to 90%, I think, from 92 for the entire season, which is not great news. Yeah,
so 92% actually, Tamanna, is just on the cusp. It's still low, but it's not a drought-like situation. Below 90% or around 90% of the long period average is actually a very, very low reading. And what I'd be more worried about is if you're talking about the overall country receiving 90%, what about spatial distribution? If certain pockets get much lower than that, then it's a problem.
Truly, and maybe that's why you're seeing a fertilizer stock apart from what we're seeing in the results coming in. So it's a sell-off. Despite the global war clarity, the sell-off intensifies, and we'll show you Brent in just a bit. Nifty support levels are at 23,300 to 23,500. Bank Nifty support levels are at 54,000 to 54,400. Small caps are outperforming large and mid caps, but just about, frankly. IT stocks are rallying on AI-related announcements. Actually, non-announcements more than AI-related announcements. A couple of things happening. A lot of IT companies shoring up their AI muscle, and on the other side, more and more reports coming about a rethink on how much you actually benefit from IT adoption, AI adoption for companies. So both of these factors coming in. Select buying is seeing in telecom and realty. Rupee, meanwhile, has strengthened in trade and yields have cooled off. This is an important session one way or the other, because there will be MSCI adjustments in the last 30 minutes of trade. and that means there are specific stocks that you should look out for. But let's just look at crude. Really, there's nothing so much to worry about on the war front. At least it's 93.65 on the Brent July. So this seems to be more of a domestic problem, perhaps. Kunal Shah, Senior Technical and Derivative Analyst at Mirae Asset Sharekhan, with us this afternoon. Kunal, great to have you on. Are you seeing any kind of trend of a bounce back in the Nifty?
Good afternoon, Tamanna. Good afternoon to everyone. Yes, I think a bit of surprising towards the second half we have seen this selling pressure. Yes, as you pointed out, domestic factors are playing into the sell-off. But I think overall the structure still remains positive till the time we are holding 23,600. That's very important. Till the time we are holding above these marks, my view continues to remain bullish. The immediate hurdle is now at 24,100. And once that is taken out, we expect the Nifty to go to a 24,500, 700. So utilize this dip probably as a buying opportunity, good level to entry, and probably you can see the momentum continuing on the upside. Bank Nifty, which was leading it, Bank Nifty has also given up. So again, Bank Nifty has faced rejection at the 50 days exponential moving average, which is placed at 55,222. So that needs to be taken out decisively for continuation of the up move towards the mark of 56,500 on the upside. So Bank Nifty, I would say avoid at the current level. There is no trade as such. Probably dips could be a better opportunity to go long on the Bank Nifty. But Nifty is something which one can start taking on the long side with a stop loss of 23,600. First target would be 24,100 and second would be 24,500 on the upside.
The question, though, is individual stocks, and where do you see the opportunities, Kunal?
So I think on individual stocks, two ideas, one on the buy side, one on the sell side. First, I'll discuss the buy idea. Stock which is looking good even in a weak market is Trent. So Trent has already been seen a bottom, which happened in the last month. And post that, we have been seeing the heart of high bottom formation on technicals. Plus on the daily chart, there has been a flat pattern formation breakout, what we have got. And we expect this move to continue on the upside. So this is a buy with a stop loss of on the downside is 4,210 and looking for targets of at least 4420 to 4500 on the upside. So that's the first pick on the buy side. The second is one on the sell side, and that is from the insurance space. ICICI Pru Life. Again, there has been shorts which have started to get into the picture for ICICI Pru. So already the stock has been trading in a downtrend. This was just a pullback what we got. And again, we are expecting this move to continue on the downside. Already there was a symmetrical triangle breakdown that had happened into the stock. And now we can see the continuation on the downside. So that's a sell for me with a stop loss of 530, looking for targets of at least 480 to 470 on the downside.
Okay. We were talking about the MSCI rejig a short while ago. Just let's tell you about that because that's something to watch out in the last half hour of trade. So in about half an hour from now, India's weight in the MSCI Standard Index is at 12.3% versus 12.4%. Inflows and outflows will take place on the 29th of May. That's today. Here is the inclusions which are expected. Federal Bank, MCX, NALCO. So we're giving you the details there of the amount of flow that's expected and the flow versus the ADV. We're seeing Indian Bank. This is, of course, Nuvama's view. Let's talk to you about exclusions. Hyundai, Jubilant Food, Kalyan Jewellers and RVNL are among them. Kunal, any of these that you're tracking?
See, overall, I think MCX has already seen a good selling pressure from the higher levels. And again, there was an immediate top that has been made into the counter. It has breached the 20 DMA. Now the next support comes at the 50 days exponential moving average, which is at 29.33. So you might see a dip towards those levels. And probably from those levels, the buying could come in. So still some 40 to 50 point downside. And then probably one can look to go on the long side again.
Okay. All right. I do want to ask about...
should we just quickly go to Sergio Gore? Yeah. The US ambassador to India is speaking. Let's just listen in.
India is joining a network of trusted ecosystems and resilient supply chains for the technologies that will define the future, from artificial intelligence to semiconductors and quantum computing. Our joint statement on the US-India AI partnership reaffirmed our shared vision for our innovation ecosystems. We agreed to adapt regulatory regimes that advance technological innovation and promote investment, deepen cooperation under the Pax Silica framework to support the supply chains of tomorrow, and foster an environment where the AI revolution is driven by the creative power of the private sector. Trust is also transforming supply chains that directly impact human health and security. Last year, the leaders agreed to encourage public and private investments to expand manufacturing capacity in India and in the US for active pharmaceutical ingredients and for critical medicines. We delivered, and India delivered in a big way. I'll share two things with you. On pharmaceuticals, we import close to 40% of our generics from India. There's a reason the United States does that. It is because we trust India. These are critical, literally life-saving ingredients that are needed in the United States. It's happening here, not in other places around the world, because of that trust. We also delivered in another big way. Every embassy gets to compete in bringing investments back home. And for us, the win-win situation is identifying both ways, investments that come here and investments that come home. And I was proud that our embassy in Mission India, in Delhi, in our consulates, delivered in a substantial way. We came in first in the world with $20.5 billion announced in new investments for the next year just from India alone. 19 billion in investments of that actually is pharmaceutical related also. So once again, it's the reaffirming of the trust.
Okay. Let's talk about the stock of the day. Sergio Gore there, everything he's saying is going to be at the bottom part of your screen. Wockhardt is undoubtedly the contender for stock of the day. It's gained in trade after getting the CDSCO nod for antibiotic Zenic, targeting multi-drug resistant infections. The drug, developed over 15 years, taps into a $25 billion global market overall. Varsha, what is the India opportunity that the street is finding so exciting?
Well, first of all, I would say whenever it is Wockhardt, it is Zenic, I would say, at least currently. And let's see what Zenic has done when it comes to the stock price of Wockhardt. In the last 5 days, the stock is up almost 30%. In the last 1 month, the stock is up 50%. So this is all because of the magic pill Zenic. But let's talk about the regulatory approval. Well, a CDSCO has approved for import and marketing of antibiotic Zenic, and of course this approval allows use in India for the treatment of serious bacterial infections, and this marks a key milestone in company's drug discovery journey. Now, why this approval is big and why everyone is betting on this drug is, of course, because it targets drug-resistant superbugs, which is a major global health problem currently, and the focus is on gram-negative bacteria, which are harder to treat and highly resistant, which Zenic will take care of that. A global phase 3 trials show 89% cure rate for Zenic versus 68.4% for meropenem, which is the current, which is currently used. And if I want to talk about which Zenic shows almost 89% response rate versus 44% for the meropenem. Now, moving on, talking about their results. So Zenic has showed strong results in compassionate use in critically ill patients, number one. And also, if I were to talk about the US FDA fast track status, which has given Zenic a fast track and qualified infectious disease product for Zenic. So that's what's the growth trigger that everyone is eyeing on. And this also indicates high unmet medical need and faster approval pathway. Applications are under review when it comes to Europe as well. Lastly, on the market opportunity, well, global market potential is estimated at $7 to $9 billion. And now this is coming from the management of Wockhardt, and the India opportunity, if you see, is large with around 1.1 million addressable cases. And overall, if you see the next leg of growth for companies, of course, Zenic, and hence, if you see the total market size is also huge. Our company has a huge potential on the back of this product, and hence India or over the world, everyone is betting on this drug.
Well, that's true. I mean, Kunal, I wonder if there's any juice left in Wockhardt after the kind of run-up it's had, and if someone holds it, should they book profits?
I think, yeah, definitely time to book some profits over here at these levels. The rally might extend toward 2100, but already if you're holding from the lower levels, definitely time to book some profits and continue holding the rest with a trailing stop loss.
Okay. Pankaj Pandey, Head Research, ICICI Direct, also with us. Pankaj, since we've been just talking about pharma and Wockhardt, let's start with your view on that. How much more run on the Zenic story for Wockhardt?
So, Wokhard, I don't have a coverage in particular, but see, within the overall healthcare space, what we like structurally more is the hospitals. I think overall sense is that this is one segment where we'll continue to see mid to high teen kind of a growth. And as hospitals sort of mature, the margin profile becomes better. What we like in that is whole hospitals in terms of large caps, Rainbow, and then you have Narayana Hrudayalaya. Besides that, HCG is another stock which we like. On the pharmaceutical side, what we like is again Cipla and Diagil and Sun. Largely, we've been sort of avoiding largely because the US pie is too large now, and this acquisition again we need to see how they are able to sort of digest it.
Got it. Okay. I do want to ask Pankaj about the IT index as a whole. And, of course, we have a special on that to talk about the various developments, but the stocks are up. In fact, that's the one pocket of strength today. Seemingly, everyone wants to launch an enterprise service related to AI now. The question is, will that contribute sufficiently to their revenues in the near term?
Pankaj, so for IT, I think whatever disclosures. Yeah. So for IT, whatever disclosure in terms of numbers are there, the AI revenues is still sort of single digits. While it might be growing, see, the only thing which is in favor of IT companies is the cheaper valuation, which is in the range of 15, 16 times compared to some 35, 36 times earlier. Otherwise, from a growth perspective, dollar revenue growth is again expected to be challenging in terms of 4 to 5% at max, which does not give enough confidence for these stocks to sort of do well. Another positive rub-off can happen only when the AI-led theme sort of cools off globally, which is yet not seen, though we are still seeing some bit of challenges coming because of AI implementation. But the AI theme globally is still pretty much intact. So, which is why I think why we might see some bounces in IT companies, but nothing is what, or when one cannot chase these IT companies as of now. Selectively, one can look at high growth names like, say, Persistent and Coforge, which are talking of double digit kind of a growth, and probably First Source. Otherwise, largely, I think this is one space which still can be avoided.
Okay, let's talk about earnings. And Asian Paints, of course, posted its numbers not too long back, and we already got you the first cut. But we've had Sharad look at the numbers in a little more detail, and he's joining us to tell you what he's made of it. Sharad, the stock has been chop and churn since the numbers came out. Doesn't seem to be able to decide which direction it's heading. What have you picked up?
Well, that's right, Alex. Of course, looking at the numbers, prima facie, the numbers are looking good. They're beating the street estimates, but there's a little bit of concern, especially in the first quarter itself. Will there be a pressure of margins? I remember the company has been taking price hikes also, and that is what aided the top line numbers as well. Higher income was already factored in, aiding the PAT numbers. Looking at the volume growth numbers, the domestic decorative business, that growth in volumes was at 12.4%, and in terms of value, it was at 10%. Remember, the expectations was between 8 to 10%, so that also came on the higher end of the range. Volume growth is, of course, coming in the industrial coating segment also, with a value growth of 12.7% and a volume growth of almost 11% coming in. But what aided the numbers is, of course, the inventory building by the dealers was there, which aided the fourth quarter, and a strong double-digit volume growth as well. Price hikes, as I had mentioned earlier, also helped. Now, the management also has come out with its commentary, but it seems like there's a cautious tone to it, and that's why perhaps the market is trying to understand whether there is a direction to this counter or not. Amit Single, the managing director and the CEO of the company, stated that the external environment remains fluid, with the West Asia conflict contributing to near-term uncertainty in demand. However, supported by the strong fundamentals and execution discipline, they remain resilient to navigate this volatility and sustain their performance as well. So, of course, it's a cautiously optimistic tone coming in from the management.
Got it. All right. Thanks so much, Sharad, for that. Let's talk about earnings in the context of Welspun Enterprises. It delivered a strong set of numbers in the fourth quarter, driven by a robust order book and deal pipeline as well. We've got Sandeep Garg, Managing Director of the company, joining us to talk about the business and the outlook going forward. Mr. Garg, thanks so much for taking the time, and pleasure speaking with you on NDTV Profit. First of all, let's talk about the quarter gone by. Pretty strong set of numbers. What, according to you, contributed to the growth that you've seen?
Thanks, Alex. Thank you for taking me on the show. So, yes, it's been a great quarter, Q4 FY26. Happy to report that we have done almost an highest turnover in a quarter of 1,192 crores at a consolidated level, and an EBITDA of about 272 crores. The revenue grew by 14% year on year and EBITDA by 31%. So I think coupled with this, that we have been able to, on the financial year, also be able to deliver EBITDA of 22.5% or 845 crores. And we have a cash balance of about 1,700 crores. So financially, the quarter has been great. It's all due to the discipline of executing well, execution excellence, picking up the right projects, and having a product mix or a project mix which is right for the long term and medium term. So that's what has contributed to our successful Q4.
Interesting. So actually, I wanted to talk about the EBITDA margins that you've achieved. They're very close to that 20% mark. The only question is, with a lot of companies now facing not just supply chain issues, but rising input costs, is that something that you're going to be able to sustain in FY27, or do you see margin pressure coming forward?
So, yes, there is a volatility in the material prices right now. And as Welspun Enterprises, we are not totally immune to it. But we are very fortunate that most of our contracts that we have are covered by the escalation mechanism through the WPI CPI escalation formula. So most of the costs that increase can get transferred to the client. The situation in terms of price variation, we are reasonably secure, and we believe that we have the ability to maintain the levels of profitability that we have, and the order book has that strength. However, the challenge still remains in the industry is that of labor supply, which is currently a big challenge for the whole industry. How that will pan out going forward will determine a lot of issues in the industry. We are fortunate at WEL that we have contracting mechanisms which take care of most of these issues. And we are very hopeful that the situation will improve and we will be able to, not only beat the guidance that we have given of 18% plus EBITDA margin, but be able to repeat a FY26 performance if everything goes right.
Okay. All right. I do want to ask about the bidding pipeline, because you've got an order book of close to 20,000 crore rupees, and a significant portion of that is in the water space. So what is the pipeline looking specifically for water and the transport project?
So the 20,000 crore rupee project order book comprises of about 10,500 crores for water, about 6,000 crores for transport, and another 2,500 crores for tunneling, and balance 1,000 coming from various other lines of business. So I think we are on an overall level, we are very, very round off order book. Water seems to be a very active place for us. As you see that the water crisis in the Delhi, water crisis in Madhya Pradesh, water crisis in a lot of places is taking place. And our company is uniquely positioned to cater to most of the requirements of the water, be it white water in terms of treatment, transmission, distribution, or a grey water that we can treat, transmit, as well as put to reuse. So we are kind of uniquely positioned there. And I think on a transport, we do have a unique proposition because of the balance sheet strength and our ability to manage complex projects, that we should be in a position to support the building of infrastructure on road on a BOT toll project basis. So we are uniquely placed, and we are reasonably confident that yes, the future has a lot to offer to us.
Goes out to get a sense of what FY27 is looking like. If your order book is close to 20,000, what is execution likely to look like in FY27? And where do you expect your order book to close based on the projects you're currently bidding for by the end of FY27?
So the guidance on the revenue that I could give in the, although it's a volatile situation, is something between 15 to 20% growth on about 3,600 crore order revenue that we reported. Now, in terms of the order book, we believe that in FY27, we should be in a position to book orders worth about 8 to 10,000 crores across all our verticals. So this should give us a clear visibility that we should be in a position to close the order book somewhere around up north of 2,500 crores.
25,000 crores, sir?
Yes, 25,000 crores.
25,000.
I stand correct. I stand corrected.
All right,
Thank you.
All right. All the best, sir, for that, and look forward to speaking to you really soon. Wish you all the best.
Thank you.
All right, so that's the management of Welspun Enterprises. Stock is up about 1.6%, just a bit of a pop while we were speaking to the management. Now, there is, of course, Bharat Dynamics on the other end of the spectrum, not doing particularly well. I wonder if we have Parth available. Okay, we will soon get our research analyst to tell you about why the stock is down. But in the meanwhile, let me go across to Pankaj Pandey to find out what his view is on Welspun Enterprises. Pankaj, you just heard the management. If they can maintain the margins at upwards of 18%, then a 15 to 20% top line growth in FY27 looks pretty robust.
So, Alex, we don't have a coverage on Welspun Enterprises, but we have something like, say, for example, Vartek Babak, which carries an order book of somewhere about 18,000 odd crores, 4 times of their FY26 revenues. What we expect from that company is a high teen kind of a growth in terms of top line and a bit of a margin improvement over the next 2 years. So bottom line growth is expected to be in excess of 25%. And water, as in within the EPC, I think is a very interesting opportunity which is going to sort of shape up. So that is the company which we prefer.
Got it. I was talking about Bharat Dynamics. The stock is about 7% lower at this juncture, more than that, close to 8%. And that's because of a weak Q4. Parth joining in to talk about what did not work in the fourth quarter. Parth?
That's right, Alex. So a lot of things that went wrong for Bharat Dynamics, starting with the delay in the supplies of their radar and seeker supplies, which actually impacted the deliveries of missiles during the quarter. The Akash missile execution, which was initially scheduled for FY26, has now been largely shifted into FY27. Also, the conflict in West Asia that is picking up pace right now has also disrupted their critical defense supply chain. And specifically for Bharat Dynamics right now, they have a high import component mix, so that is actually putting a pressure on their operating margins as the conflict has not resolved completely yet. The company has a huge order book of 26,000 crores, but the management is not able to convert it meaningfully into sales. And this execution visibility, this uncertainty about their execution visibility is what is hurting the investor confidence currently in the markets.
Got it. All right. Pankaj, quick view on Bharat Dynamics, stock under pressure today for good reason.
So previous guidance, previous guidance, we were expecting some 40% kind of a growth, but numbers were otherwise 27% kind of a down in top line. I think visibility-wise, no challenges because you are sitting at 10 times your FY26 revenues in terms of order book. I think till the time execution does not come up, things will remain challenging. But we've seen in PSUs, except for Bharat Electronics, you get this kind of a volatility on a quarterly basis in number of stocks. So I think a better way to sort of look at stock like this is on an annual basis. But numbers are definitely disappointing for sure.
Okay, let's just take a look at the other disappointments that we're seeing in the market right now. But before we do that, Kunal, a quick view on Bharat Dynamic. The entire defense space looking squeezed, but BDL specifically?
I think definitely a breakdown that has happened into the stock. So this might continue its correction. The next support zone for the stock has been around 1100. So that could be the next support. And once that is broken down, you can expect further selling pressure towards the mark of 950. But if you have talked about defense, I think one stock which you should keep on your radar on the buy side is Madani. I think overall the larger term structure looks extremely bullish. There has been significant buying interest coming from the lower levels. So that's a buy. One can go on the long side. And I'm expecting for the upside somewhere close to 460, 470 is where the stock would head towards.
Okay, we were talking about disappointments. I want to pull up Natco Pharma for you, about 11% down. Jyoti CNC Automation not looking great. Praj Industries, again, unexciting numbers that have come in to be very
That's one
kind.
way of putting it.
Yeah, Fact, Fertilizers and Chemicals, Travancore Company, again, not the most enthusing numbers that have come in. I think it's on a 5% lower circuit, if I'm not mistaken. Okay, no, it's 4.93%. It's above that circuit right now. MCX facing a bit of pressure as well this afternoon. So you have enough of those pain points there coming in, and apart from, say, a NetWeb, Signature Global, not too much which is exciting, has been painful by all accounts. What would be the verdict overall? Do you think numbers all said and done have been decent when it comes to corporate earnings?
So our sense is that when we look at Nifty earnings have grown at about 5%. So on a disappointing side, not that great set of number was expected. The expectation was 8% kind of a growth. Now, the positive surprise was definitely on the mid cap and small cap side, with a growth of somewhere about 28 odd% for mid caps, and I think somewhere about 21 odd% for small caps. So the broader market, definitely the earnings have been pretty good. In fact, last 3 quarters, if you look at the broader market, earnings have been in double digits, or good double digits, or 20% plus. But Nifty, because of some of the other challenges in the constituents, has not been sort of delivering. And which is where why Nifty is yet not sort of performing, whereas the broader market or the market breadth looks good. So I think the opportunity lies more on the mid cap and the small cap side, and large caps, so one needs to be selective.
Okay, let's put the corporate radar now on Gujarat Alkalis. It's posted a mixed fourth quarter with revenue growth overshadowed by higher power, fuel and operating costs that seem to have weighed on margins. Looking ahead, the company is sharpening its focus on specialty chemicals and green energy with new investments targeting semiconductor, solar and electronic sectors. Let's speak with Avantika Singh, Managing Director, Gujarat Alkalis and Chemicals, of course, IS officer as well. Ma'am, thank you so much for speaking with us today on NDTV Profit on your quarterly results. What do you think has been the pain point in the fourth quarter in your view? Of course, if I look at the profit figure, it's looking good, but I believe that's because of what has come from the joint venture.
Thank you, Tamanna. First of all, if you see our year ending and the quarter results, we've done much better than the previous financial year. Our PBT has increased from 10 crore to 44 crores. The main factor is, like you said, the power, fuel and utility costs are a little higher as compared to our industry peers, but we have a planned strategy for bringing down the power cost even in this financial year. If you see, there's a 52 paisa per unit reduction from 8.42 per unit to 7.9 per unit in this financial year. And in the coming years, especially in the current financial year, we have an additional RE capacity of about 138 megawatt, which is likely to be commissioned, which would further bring down our power cost and increase the share of RE, green energy, in our overall power basket to about 60%. So, like you said, we are focused on reducing our costs. We've embarked on an ambitious strategic transformation exercise by the name of Project Ahwan, where we are in a systematic cost-cutting mode to improve our competitiveness in the industry, and the focus is reduction in power, fuel and utility costs and improving efficiency.
If I may ask, what is the timeline? Sure. Yeah. Ma'am, if I may ask, you're talking about a new strategic outlook you have to reduce costs and especially power costs. 2 parts to this. What is the kind of expenditure or capex you need to put in place to make those transitions? And by when will you be able to see the benefits accruing of these lower costs?
So in the board today itself, we've first approved the energy efficiency improvement measures like replacement of our cell elements, which is a routine but a regular, a very critical capex exercise. The idea is to improve our efficiency of energy usage and optimizing our costs. Further, we are entering into the purified chemical space with the purified hydrogen peroxide unit for electronic grade for the semiconductor ecosystem that is now coming up in Gujarat. Further, an IT and digitization strategy spread over the next 2 years with an investment of about 100 crores is on our radar. Overall, the outlook for the next 2 years, if you see, is going to be the reduction in power costs by bringing in and increasing the share of green energy. Like I said, 2 projects with CleanMax and Aditya Birla Renewables. Our joint ventures are going to come and commissioned within this financial year, which is going to substantially reduce our power cost. And the focus is going to continue over the next 2 years. Further, other capex projects, just to mention, we are going to add further capacity in KOH. This year itself, we are going to commission our HCl synthesis unit, our caustic flaker, and we have a major capex decision done for the food-grade phosphoric acid expansion, which will be the next 2 to 3 years.
Ms. Singh, therefore, good afternoon. This is Alex here. What is the value? Good afternoon. What is the number that you've set aside for FY27 capex?
The FY27 capex should be around close to 300 to 400 crores.
Good. I just want to ask, and one part, of course, of driving those margins higher is controlling costs. The other is through product mix. And everybody in the space is looking towards increasing presence in specialty chemicals. So can you give us a sense of how specifically chlorine derivatives and the specialty chemical demand is and what your share could be heading into the end of FY27?
So basically what we're looking at are more chlorine consuming products. So the idea is to first try and increase our share of solid caustic, that is the flaker unit that is going to be commissioned. It helps improve our exports. Further, like I said, we've planned for our phosphoric acid food grade because this is one product where we've seen consistently high product realizations and has done well even during crisis periods, including the current crisis. And branching out from caustic soda to KOH is something that we are strategically doing to, kind of improve our product mix, widen the basket, while focusing on chlorine consumption, but try and branch out into specialty chemicals, purified chemicals. We've in fact planned a growth strategy for the next 5 years, and the focus would be to diversify our product basket and reduce the dependence on caustic soda for our margins.
Ms. Singh, I just want to understand though, there must be some goal in mind with regard to the product mix and how much specialty chemicals will eventually contribute with regard to revenue, right? And what the implication is for margin. I'm just trying to understand that entire picture.
Alex, I think this financial year it'll be very, it'll be too premature to give you any numbers. We are just moving into specialty chemicals. Like I said, the electronic grade hydrogen peroxide plant would be the first one. We are going into chlorotoluene downstream products, but they would still qualify as bulk chemicals right now. Like we said, our growth strategy focuses on specialty chemicals, but to give you a number on the exact share of our revenues or sales in terms of specialty chemicals, we'll have to wait for at least 1 or 2 years more.
On an overarching,
a substantial number would come from specialty chemicals rather than our bulk chemicals project.
I understand. So therefore, on an overarching basis, if you can leave us with, if not an exact guidance, but a broad range perhaps on top line growth and on margins that you anticipate in FY27?
Till now, the current quarter has been, in fact, very good for us. Though the prices of our raw materials have been volatile, whether it is methanol or toluene, but then we've been able to strategically price our final product in such a way that the current quarter in terms of margin realizations has been quite good. It looks very promising. So without giving you a number, I can assure you that this financial year is going to be one of our best.
Okay. Thank you so much, ma'am, for speaking with us. That is Gujarat Alkaline and the management talking about how they are working on moving green. I think this is going to be a transition period for so many companies looking at what's happening right now. And, Pankaj Pandey, I just want to come to this point. You're seeing just the March bit of this entire quarter that we are seeing reports on right now, right? Q4. Just March has wreaked havoc on the balance sheets of some companies. Now, look at what's going to happen in Q1 with April, May compounding this. How do you see this panning out for a whole host of companies which are already showing signs of trouble in just March?
So Our sense is that a lot depends on how high the crude oil prices sort of sustained because we look at a lot of sectors and I think overall sense is that if the prices don't come down, then possibly in Q1 and Q2 onwards, especially Q2, we'll start seeing pressure on margins for a lot of companies. And while yes, companies have been taking calibrated price hikes, but not to the extent the raw material prices have gone up. See, the only hope is that some deal happens there and in the Gulf side and overall the crude oil prices come down quickly. But in case if it does not, then I think obviously we expect some downward revision in the margin for a lot of companies and right from auto because we are going to see second round of impact of this inflationary pressure across segments. So I think that is the biggest worry for the market as of now.
Got it. Okay. Thanks so much for that. And let's just slip into a very quick break. On the other side, we'll get you more stock-specific action, starting with a bull versus bear case on PG Electroplast, a stock under a tad bit of pressure. We'll be back before you know it. Stay tuned.
Investments in specialized investment fund involves relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all investment strategy related documents carefully before making the investment decision.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Niraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit.
And the award goes to
Tamanna Inamdar, Managing Editor, NDTV Profit.
Leading the newsroom, shaping the narrative. From stories to impact, a voice that matters. Tamanna Inamdar, among India's most influential.
Welcome back. You're watching India Market Close, and the smile on the face is because at the end of the day you have to smile no matter what happens. Look at the Nifty right now. Let's just pull up the Nifty as we're going into that close. It's I mean, now it's even worse. It's a 400-point downtake. I'm not sure what's happening. Is this the MSCI rebalancing?
Quite likely.
Is this a concern about monsoon? Tough to say, tough to say. We'll ask that question to Deepak Chinoy, CEO of Capital Mind Mutual Fund, and Nilesh Jain of Centrum Broking, who are joining us on this leg of the show. But gentlemen, just stay on for another minute or so, because I just want to go across to Puneet for our bull versus bear section. And this is a segment where we take a stock and we give you both sides of the story. PG Electroplast seems like a good candidate for it today because it started low. Results were disappointing. They have decided not to give any guidance, but the stock is still 1% up. What are the two ways of looking at this stock, Puneet?
Well, that's right. It's one of those perfect candidates because there's a lot of commentary made by the management in yesterday's con call, as well as what brokerages make of it as well. So, as you rightly mentioned, profits down 55%, missed the FY26 guidance for both revenue and profits, and no guidance for FY27 as well. So that's the first bear case. But the management is expecting to target a better than industry growth in FY27. Now, for industry, FY26 was down 15%. PG Electroplast was up almost 5% odd at this point of time or so, but not too much in terms of what the expectation was. So that is the first key aspect to watch. The other aspect that will be negative for the company in FY27, that they are expecting the AC business to have lower margins in FY27. So FY25 margins were at 10.7, fell to 8.4, and now will consolidate at 8%. So that might be the other kicker, in terms of the profitability impact in FY27. But in the other aspect, the washing machine business, let's go across to the previous slide again, because the washing machine business is starting to take some pace now. So 52% growth in FY26, 30 to 35% expected in FY27 as well. But they will have to watch out for the margins, especially on commodity cost and forex. And that is the third key one, because inventory was one of the biggest issues for the company in FY26. You saw that 20% stock fall post quarter two results last year, and they've expected that 1600 crore inventory continues to be very high at the end of quarter four, but the guidance is very, very strong here, and hence the bull versus bear candidate, expecting it to fall to 900 crores by the end of quarter one. So June end is what the expectation. It will be something to watch out for if they achieve it or no. And finally, in terms of compressors, big costing for the companies in AC makers. If they are able to do that, expectation is by Q4 of FY27, the plant comes on stream. But for this year, it will be a tough earnings. 16 to 18% estimates have already been cut in FY27. So this is more of a FY28 story, and hence an ideal bull versus bear candidate for today.
All right. Thanks so much, Puneet, for that and for laying those scenarios out for us. Deepak Chinoy, question to you. We're seeing the Nifty 50 at the low point of the day, down 1.6, 1.7%. Is this the MSCI rejig? Does it present opportunities?
Well, I guess to some extent there is, possibly that, but I don't know the answer to that because the rupee is actually appreciating, and it doesn't look like they're taking money off the table. So it may be individual stocks that they may be moving. I don't believe that, if the rupee is appreciating at the same time that you're seeing such a damage in the index, that it could primarily be an index rebalance. It could be part of it, but, a steep fall that has happened in the last, say 1 hour or half an hour, maybe, some key players looking to, either exit their positions or something. It's the last trading day of the month. It's also a little surprising that this happens now. But yeah, if it is a rebalance, that could be one way of explaining it. But honestly, my simple answer is I don't know. I don't know if it is this or that.
I think that's fair and honest to say you don't know, because actually who can ever guess what's happening in its entirety? We can only guesstimate. But the facts are that crude is below 93, Brent nearly at 92. Rupee has appreciated, as you said, Deepak. Your results are not half bad, especially in the broader markets, right? The small and mid cap are doing fine. Yes, monsoon is weak, but is that enough to worry? Is this maybe another tranche of FI selling taking place because of the MSCI rebalancing, some NAV adjustments, you think, in the mutual fund space as well?
Usually mutual funds don't trade at the last, in the last day nowadays because The TER requirements at the mutual fund level have ensured that we have to report annualized brokerage and transaction charges on a daily basis, right? So it's almost like if you do trade today, then your brokerage transaction charges of today will be annualized and assumed to be what you will be charging for the whole year. So you will find some mutual fund showing 40% or 50% TERs on a particular day. There's a BER, which people haven't yet gotten into. So the TER is a slightly different measure. So it's possible that most mutual funds don't even trade today. So to the extent that they would otherwise be supporting the market, maybe they're not there. So that might be one thing to look at. But I don't think it's an NAV rebalance thing at all. I mean, nobody would manually want to beat their NAV down at the last.
I know. It just seems, just wondering what's happening, because look at the India VIX as well. If you really want to pull up all of the indicators, if I look at Brent, what's happening globally at one end, that's fine. India VIX is about 8% up, 7.5% up. So there seems to be some real concern there. Deepak, this IMD prediction today, the second number that they put out, actually has brought down the monsoon rate from 92% to 90% for the season. That's a big concern, you think? Although that did happen in the morning. You needn't have seen this kind of huge 250-point drop in the last 10 minutes as a result of it.
Yeah, I mean, look, at some point, you see IMD predictions in the past. There have been years in which the early predictions have been 90%, and then they've gone back up to 95, 96 of long-term averages. I think this year, particularly given it's a super El Nino and there will be changes, I believe we might see some surprises in these estimates going forward, perhaps from too less to too much at some point. So I wouldn't pay that much credence to these numbers in terms of saying there's going to be a reduced agricultural output or that we don't have the logistics changes that will support some of these imbalances. But yeah, I mean, should this support a daily thing? I really don't know. It would have probably been selectively towards some companies and not the others. Not necessarily everyone suffers because of a bad monsoon. I don't know whether that has an impact. It does have a medium-term impact if it does affect agricultural output. But again, there I feel it's a little too early to call even now.
And let's remember that there is a significant portion of cropped area that is catered to by irrigation. And so therefore 55% of the gross cropped area, half of the net sown area. So there is a pretty substantial amount that is also taken care of by groundwater. I want to go to Nilesh. Nilesh, what do you make of the charts right now? Can you draw any conclusions from the intraday charts? And how do you position yourself at the end of the month and the start of the new one?
Very good afternoon, Alex. Good afternoon, everyone. Well, Alex, in last couple of minutes of trade, a sharp drop that we have seen looks like mainly because of the MSCI rebalancing, because historically we have seen that happens between 3 to 315, and that's what we are witnessing right now. See, the closing is not very good. If at all Nifty closes below 23,680, that's the 50-day moving average, then that will be considered as a bad close. But not expecting any major sort of correction because there are multiple supports in place. The important support that is placed at 23,300. So that's a very important support to watch out for. If at all we see any further decline from here, I think that could be a good opportunity to buy, because we have seen the Nifty has been more sort of a range bound throughout the May series, and similar to what we can expect in the June series as well. So 24,000 is an important resistance, 23,300 is an important support. So that's the range which is still intact as of now. And the IVs once again have surged beyond 16, but on a broader scale, it is very much in the comfortable level to what we have seen earlier at the level of 20. So 16 is still a comfortable level. Bank Nifty, where we saw some bit of outperformance coming in today, but once again, we are witnessing some bit of selling pressure once again, and it is likely to end near about its 50-day as well as 21-day moving average. Both are placed exactly at 54,500. So from a closing perspective, both for Nifty and Bank Nifty, is very important that they should defend their respective support from an intraday perspective.
Okay. Now, what is the MSCI? Just pull up that those lines on MSCI rebalancing, because various estimates on how much is the outflow for MSCI. 7,000 to 8,000 crores is part of it. So, is this huge outflow of money what we're seeing? And then my question is that, is this an opportunity then for domestic investors to come in? So remember, India's weight in the MSCI standard index has not changed that much. It's from 12.4 to 12.3%, and those outflows are happening today. We have some of those inclusions, but that overall figure is estimated at 7,000 to 8,000 crore rupees. I'm wondering, Nilesh, is this is an adjustment more than anything else? It's because Indian markets are so vulnerable right now that you've seen this huge, nearly 400-point drop on the Nifty. Is this an opportunity to buy?
Well, Tamanna, absolutely, it's an opportunity, but I will not advise to jump and buy right now, because you have a weekend ahead, right? So better strategy would be to wait for a Monday opening and see the global markets as well. As of now, the global picture is looking stable. Brent crude is at comfortable level. Dollar index near about $99. USD INR have also cooled off from the highs of 96.96. So, and even if you see in the US market, which is trading at all-time highs. So the broader picture in the global market is not that worrisome as of now, looks stable. And if this is happening merely because of the MSCI rebalancing, I think that's an opportunity. And if you get Nifty towards 23,400, 23,300, I think that's a very good entry point in terms of start making investment from a fresh perspective. So better wait for some more time. Maybe on Monday morning you'll get a better picture. But I believe this is a very good opportunity.
Monday morning might be too late. You might get a better picture, but Deepak, for anyone who's in the business of long-term investments, are you looking at these opportunities and finding them lip-smacking, or are you now feeling a little concerned about what happens next? Because think about it, for the first time, we are as close to a solution in the Strait of Hormuz than we've been in weeks. Brent, I'm not saying Brent is back below 90, but it's way off.
Yeah, long-term bullishness is a given here, because I think India will do well in the longer term. However, these short-term imbalances will happen. We are supposed to get volatility in the market. These are markets. They're supposed to move 1-2%, randomly at any time. We just didn't get a period of a lot of this for a long time, but now it's more common. And I think that is what has perhaps surprised us. But in general, a 1% fall does not present a big opportunity. If you look at the numbers that you were looking at, there's a bank that was supposed to see 19x of its volume being sold today, let us say. But it's that bank was flat or almost up. So it's not even that, the flows because of this rebalance have caused this kind of damage. So it's difficult to predict what it was. But I generally feel that, any drop in a stock that's forced selling, that might be an opportunity, and that's there in a lot of stocks even today. And in other cases, there are stocks that are perhaps finding the right valuations because maybe they were overvalued in the past and coming down. So the difference between those two will be the opportunities. So where you find that the prices are way below requirements, there will always be opportunities. There will be other opportunities to not hold a stock after, say, certain fundamental changes or results or commentary that you might have seen. Not much of a change because of a 1% fall. The market had fallen 5%, I might have a more reasonable answer.
I think if you look at it over the month, you might see a bigger number of fall. And, you should pull up the monthly chart for the Nifty because it's been painful. But I get your point. Today is maybe just one additional big pop that we're seeing. Let's talk specifics. Indigo earnings are expected to come out post-market hours. Q4 is expected to reflect pressure on profitability despite modest top-line growth. Let me go across to Somit Sarkar, who's getting us that preview. Somit.
Well, yes, to be precise, 3 headwinds that the company had to take on in the fourth quarter of FY26, and pretty much weak set of numbers is what the street has been anticipating, though revenues up around 2% on a YOY basis. EBITDA is expected to fall by more than 70%, while the company is also expected to report a net loss of close to 2,300 crore rupees as against a net profit of close to 3,068 crore. But do remember that the base was quite high for Indigo because last year it was Mahakumbh, which led to good revenue growth and good yields, and hence you're seeing a decline on the yield front as well. Now, yield is average fare per passenger per kilometer, that is expected to come down by around 2%. So what were the headwinds in the fourth quarter of FY26? Firstly, the international air traffic was impacted because of the Middle East war. Second was higher fuel prices on the international routes only, not on the domestic routes, but on the international routes, higher fuel prices had impacted the operations. And the third and the biggest culprit for Indigo in the fourth quarter was rupee depreciation. Alone because of rupee depreciation, the forex loss for the company is expected to be around 4,000 crore rupees. Now, because of this forex loss, the company is expected to report a net loss in the fourth quarter. Now, rupee depreciated by nearly 5.5% during the fourth quarter of FY26 from 89.9 to it depreciated to nearly 94.8, and that was the major reason why the numbers are expected to be weak. If you remove the forex loss, then the EBITDA is expected to be down by just 14%, which is actually not bad for Indigo in the fourth quarter. So the key thing to watch out for Indigo would be what is the forex loss that the company is reporting, how much of this is notional, and how much of this is actual loss that the company incurs. Apart from that, commentary coming in on pickup of air traffic, what is the impact of higher fuel surcharge that the company has imposed, the net impact of higher fuel surcharge and higher fuel cost, and also what is the guidance that the company is giving for capacity addition for FY27 will be important to track.
If there is one company from whom we want to hear about what's happening now rather than what happened in Q4, I think it's Interglobe Aviation, just because of how the whole world and picture changed dramatically on crude prices. It happened in March, which will reflect in their earnings, but it just got worse subsequently. IT stocks are the only green bright spot in the markets today for several number of reasons. Emphasis unveiled its enterprise AI platform. Wipro expanded its ServiceNow partnership to scale agentic AI, and the street is betting on the next growth cycle. Puneet joining in with more details.
Well, thank you for that. So, as you rightly mentioned, Nifty IT continues to be at one of the top gaining sectors, and you're seeing these direct plays and the name that you mentioned, along with the indirect ones as well. So, the likes of E2E Networks, Netweb Technologies, Blackbox, all of them gaining in trade today. So, the AI chips, data centers, all of those names continue to do well as well. I just want to quickly highlight 2 key updates. One has been on Emphasis, and we spoke about it with the management as well. Launched their own enterprise AI platform, and what they've said is that they believe that AI, has reset the industry at this point of time with the tech arbitrage versus the labor arbitrage argument now largely over. So it's the headcount addition and revenue growth era is now over, according to the management. They've also said that enterprise AI has one of the biggest gaps where they want to place this new product in without human intervention and operate autonomously altogether. So that's what they launched today as well. And in terms of Wipro, their ADR jumped 18% yesterday on partnership with ServiceNow. That has been expanded as well, as you rightly mentioned, and they will integrate their AI service platform with that of ServiceNow. So that's the second key update. And the third one on Anthropic, doesn't stop at $965 billion, and the revenue per employee, you can see the massive gap of $10 million for Anthropic versus $51,000 for the IT players. So these are all the key updates for today.
No, but then the point is Anthropic's update has got a Netweb firing. Let's pull up Netweb. The Nifty IT is also cooled off, decided to join the pity party on the markets. But Netweb is 14% up because market is hungry. Find us some AI story and we'll jump in.
No,
and
but
that's what's happening with
IT picture is quite...
it's cooled off considerably. Just look at that Nifty IT.
It just showcases the picture today, right? There's one bright spot, and even that has capitulated.
So having said that, not to cause panic, because you're probably seeing our screen and saying, kya hua? This is an MSCI rebalancing. It was expected to happen. It took place in the last half hour of trade. We told you at the start of the day and at the start of the show that this will happen. And so this is another gush of money possibly flowing out, just 1.5% down. 23,581. Not great levels for the Nifty. 326 points down. Let's pull up the heat map as we're getting into the closing bit. Just about a minute to go. Wow, at least Tech Mahindra is holding up.
Yeah.
So is Wipro. Everything else is looking quite tough. Power Grid, look at Bajaj Auto. It was the star for the most part of this week and the last. Not really working out for it. Indigo, before its results, looking quite shaky. ONGC, because we hit on all sides, right? Crude is also coming off. So ONGC is also looking tough.
Yeah, absolutely. And ONGC earnings weren't the best either. So this week has been painful. But Infosys now moving into the red. TCS as well, perhaps in the red. Yeah, it is. And a few other counters, right? The heavyweights. HDFC Bank losing ground, HUL losing ground, HDFC now 1.5%. Reliance Industries also losing quite a considerable amount, over 2%. So it's heavyweights, and I think pull up the contributors chart and you will see exactly that. You will see Reliance Industries, HDFC Bank, ICICI Bank, Bharti Airtel. So heavyweights losing, not too much being contributed. 24 points, 25 points, doesn't move the needle.
Yeah, no, the needle's definitely in the other direction. I want to pull up two things for you. The India VIX, even as we're talking about MSCI balancing, look at where the India VIX has ended. This is making me a little uncomfortable, frankly. 9% spike on the India VIX at 1635. What is the street fearing that we don't know of yet? Is it just monsoon, MSCI rebalancing, or is there something more? That's all I would say. I want to look at the Nifty for the month. The Nifty, the Bank Nifty, the small cap and the mid cap, because remember, May is over. May has been tough. Over a month, you've lost about 2.5%. So maybe that picture in all not as bad, but 2.5% of the month is really a bit painful because it's already steadily been worsening. The Bank Nifty down about 2%. Let's pull up the mid cap and the small cap. Now that's where there has been some value created. But you know, when we're saying, oh, the mid cap has done significantly better than Nifty, not significantly better, 1.5%. Even the small cap, 1%. Your portfolios have not moved in the last 1 month.
But you'll take that. I'll tell you why. Because April, you saw the mid-cap index gain about 13% at the index level, and you had the small-cap index up about 17%.
Yeah.
So it's building on that. At least you're not losing ground. The Nifty 50 loses from about 7-8% of gains in April to about, 2.5%, as you pointed out.
Okay, so you're still okay. Let's put up the weekly for the Nifty and then shows you a starker picture, perhaps, of how you've ended. The weekly chart for the Nifty is going to show you that you've had, about 1% down and 1.5% of it coming in from here. The small cap and the mid cap for the week. We'll just look at that very quickly before we close out and look at the sectoral indices. Remember, we have editors cut up next. Has also been pretty much flat. So it's neither here nor there. Not too bad to end in a stable, steady space, and the small cap about 1% up.
Yeah, I think that we should call it on that note because we've got quite a bit to discuss on the editor's cut. That's up next. Stay tuned.
Investments in specialized investment fund involves relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all investment strategy related documents carefully before making the investment decision.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Niraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit.
And the award goes.
Welcome. You're watching the Editor's Cut, and so much to unpack this week, where, you know, for the longest time, the idea was that India marches to its own beat. No matter what's happening in the world, we were steady. This was maybe between 2021, 22 and 23. No matter what happened in the world, it's become the reverse. The world is fine. India is the one that's feeling shaky. Doesn't it feel like that this week, guys?
Yeah. Absolutely, because I think if you have to look at performance as well, we are one of the underperformers versus the kind of gains that have come in for global markets since the time the war has started. So absolutely, that's what we're staring at.
And you know, the worst thing is that now you have this monsoon headache. So what's happened in Friday's markets, and I think that's important to unpack first, this MSCI rebalancing. Why this extent of a reaction? Is this something that was expected, you think?
So usually, you know, whenever you've seen this MSCI rejig happen, in that last half an hour of trade, you do see that downtick that happens in terms of markets. Now, in terms of the quantum, that is what is important right now, according to me, because you're talking of $1 billion worth of outflows. So you are going to see that 7,000-8,000 kind of a FI sell number that will be coming in today. Hopefully, this is not something that should irk investors. That why is it that they've actually gone to this extent, but it's only because of the rebalancing, and this is what they're forced to do because of the rebalance.
No, but that's fine. That doesn't explain the India VIX spiking the way it has to 9%. There's something, I don't know. It's not looking as simple to me as rebalancing and the usual
I think if you anticipate,
play.
And the street had anticipated that there would be selling to facilitate the rebalancing, then positions get taken accordingly, right? Because if the whole world knew about it.
Yeah, but then to add to that, you're still talking about the kind of volatility that does exist is what Tamanna is mentioning, right? There's no certainty still.
Well,
and
if you
both
look
are coming together.
But if you look at Brent prices are actually better than they've been for a while. You're nearly at 92. Okay, so here's my take on what's happening this week, and tell us what you think. I think what's also shaken confidence a little is this IMD forecast that has come on Friday. Monsoon is a bigger headache right now for Indian markets maybe than the Strait of Hormuz. IMD's second forecast is worse than the first one. So monsoon is now expected at 90% versus 92% earlier. And couple that with muted demand. Now, why am I saying that? Sesha sent a story today, guys, saying that AC sales, despite heat waves, right? Remember last year they were upset because you had a very heavy and prolonged monsoon. ACs weren't selling. This time is the perfect condition. AC sales are not as much as they were expecting despite that. So I think a muted monsoon coupled with muted demand could be a bad idea. And while the world seems relieved by the US-Iran de-escalation, the joy seems to have skipped Indian markets. Another data point, I don't know if this has gone under the radar. Through the week, the Iranian news agency, Tasneem, has been putting out updates of how many ships have actually sailed through the Strait of Hormuz. And for the first time since the crisis began, you've had 40 ships sail through in just this week. It's usually about 150 for a day. Per day, so it's much lesser than that. But that is opening up even as these negotiations are going on.
It is a positive, but till what extent will this continue is the question, right, Tamanna? Because here you're talking about from that 150 a day, you've moved to at least 40 right now, where there was no movement at all. will this 40 increase over time is what we need to see, and how much time does it take? Because in fact, yesterday we were discussing about this, where the choker block, the point at the port.
The choke point.
Yeah, the choke point at the port, where we were talking about exporters who release in a week's time. The delay is 30 days right now because ships are not coming. Exporters have loaded their cargo and they're just waiting that when can they go, because this is just the feeder.
Agreed, but this has been happening from a while.
Yeah.
Now for the first time you have at least something opening up. I'm saying you're nearly at the end. It seems like you're closest to the end of this than you've been in a while.
And I think the point that you made earlier in the week about there being a window for Iran to close this out is coming to the fore right now, because you've had over 3 months of this conflict and ultimately everybody is looking for alternative routes. Of course, it doesn't happen overnight, but it will eventually happen. 20% of global crude was passing through the Strait of Hormuz. I would hazard a guess to say that it's obviously significantly less than that right now, but that gap is being filled surely over the course of the next.
Yeah, through Saudi Arabia, through UAE,
Absolutely.
they have those alternate. Another thing which I found really interesting, and we spoke about it, is the AI excitement and the AI super cycle. Are we seeing the first signs of this possibly being a bubble? And I say this with trepidation. It's not just what Uber has said. When Uber realized that they have blown through, their CTO came and said, "Bhai, we've blown through our entire year's AI budget in 4 months."
4 months.
The COO is saying, "I can't quite see what is going to be the use." Of course, the CEO is very excited. He's saying AI is going to turn our engineers into super engineers. We're hiring less as a result. But at some point, and this is what Happiest Minds told us today, CFOs of companies are going to come and say that where is the clear link between AI spends and outcome?
Yeah.
And maybe that will happen sooner than later.
In fact, I was just reading a Twitter post, I don't remember which CEO was it, where he's just got a monthly bill of Claude, which is been spent in 5 days. I don't remember which one.
Yeah,
and
there
now,
are various stories like that. Yeah.
Which are doing rounds, that we don't know what's happening and exactly where the productivity is if you have to look at that 5 days spend versus what we've got.
Yeah, there was another piece that we spoke about, which is $500 million spent in a matter of a month. So I think the jury's out on that, but the signs are there that this might be a little inflated, if not a bubble, right? My take, I'm talking about rupee assets, right? I'm talking primarily about equity. This is not a time to bet against rupee assets. And I must say that I've borrowed a bit of this from a DSP note earlier in the month. And they're talking about the real effective exchange rate. Okay. Now, what is that? You're looking at the nominal effective exchange rate, which simply looks at the value of the rupee versus several other currencies. So you talk about the USD INR as a pair and where it is right now. But you add inflation to the mix and you look at India's inflation vis-a-vis several other countries, and you get a complete picture of the competitiveness of the Indian rupee. By that reading, it is currently at below 87 or thereabouts. A reading above 100 points to not very competitive. A value below 100 points to high competitiveness. Now, we've seen this value at no other point apart from two, which is the 2013 twin balance sheet issue and the 2008 financial crisis. At no other time have you seen a value this low. So
where is it currently?
It's around 87.
Okay.
Right? So which is why this is not the time to bet against Indian rupee assets. To say that the rupee, because it's so undervalued, the downside from this point might actually be limited. Having said that, there is also this big debate about, and Jeffries had a note out about the SIP book and SIPs being responsible for the rupee decline, right? And I think that it's a very interesting argument to make, but I don't think it's a fair one. It assumes that Indians should not be doing a SIP and you should wait for the market to correct and then deploy. Having said that, you talk about the history of dollar cost averaging very quickly, right? And this is a situation where it goes back to 1949. It's not a new concept. And the SIP is effectively just that. And beyond that, there are several other countries that have this monthly flow, as well as looking at Japan, and it has what is called the Sumitate. And you have flows of 940 billion yen per month, which is 56,000 crore rupees.
Yeah.
So it's not just the Indian 32,000 crore rupees that flows into equity. It happens everywhere.
Yeah, but everyone's currency is not in this
Sure,
shape.
that's what I'm saying. So you can't equate that. You can't equate it and say,
No,
oh,
they have. So what? It doesn't mean that Indians stop investing.
Yeah, and there's nothing wrong with doing
Since we're talking about Japan, just as an aside, I saw a story today saying Japan has stopped import of mangoes from India because of whatever XYZ reason. And my first thought was good, more for
mangoes
us.
for us.
More mangoes
and
for
export
us.
quality.
More export quality mangoes for us here in India. Maybe the same goes for the point about SIPs.
Yeah, but the way I was looking at markets this week is mainly the kind of tug of war that we've been talking about, because we've been massively locked there. Now, if you talk about the frontline indices, I'm talking about key levels here. Nifty 50 has been fighting to sustain that 23,800 mark and 24,000. And the Sensex has been hovering around 75,800. And these have been crucial levels. And till we talk about my editor's cut or take today, we already have visuals of Dheeraj Agarwal, our guest editor, who's just walking in. Those are live visuals. He'll be here right away any moment. But till that time, I think we need to ask him, what is that institutional divide going to look like? Because a structural shift is what we are seeing, wherein you have FIs who already pulled out. In fact, today's number will be pretty large. Your DIIs have come in as well. And your mutual fund SIPs are the ones who are coming in as a retail participant. And that's what Alex has been talking about. In fact, we have Dheeraj who's with us. Dheeraj, welcome to the NDTV Profit Studio. It's always an honor to have you.
Thank you so much.
Yeah.
Good to see you, Dheeraj.
Pleasure to be here.
Did you like that live welcome that you got coming in?
I felt quite weird, honestly.
You should have practiced
It was complete stardom.
It felt a bit like a bridal walk. Neither it's my wedding, nor am I a bride.
No, but it looked pretty good.
You're a guest of honor. You're a VIP.
Okay.
The bride is at her wedding.
If you say so, but I've never done this before.
No, it looked good. It looked good. Don't worry about it. Are you worried about what you're seeing in Indian markets right now, or is this some MSCI rebalancing, rejig,
No, I'm worried.
cough and cold sneeze situation?
The MSCI rebalancing probably impacted the market in the last 30 minutes. But if you actually think about it, in the last few weeks, every time there are strong signals of war getting over and things normalizing, Indian markets are not reacting as strongly as what normally one would have expected, right? And again, within the markets, I would break it into two parts. I mean, large caps are not reacting. Mid caps and small caps are generally doing much better. And I mean, I have my reasons for it.
What? Let us know.
There is lack of growth, right? So this is, I think, 6th or 7th quarter in a row that Nifty EPS growth is sub 10%. So even for March quarter this year, Nifty EPS growth is 9%. I mean, one can blame this on probably the war and the oil price spike, etc. But if you look at 5 quarters before that, it was also 7, 8, 9% range. So there is a little bit of a growth challenge that at least the large cap section of our market is facing. I mean, the mid and small are in the 15 to 20 range.
No, so that was the point I was making. Is it fair anymore to judge Indian markets and their performance by the Nifty? The Nifty, I'm sorry to say, is beginning to seem a little out of date. Because of its high, might be a controversial statement to make, but it is seeming a little out of date because of the high proportion and weightage that IT has in it, for example.
Well, IT is only 7% or 9%. I think
so between
below 10 now.
between IT and banks and maybe one or two heavyweights, you're just pretty much done.
Yeah.
How representative is it of growth pockets in the economy right now?
While it's not, I mean, I agree with you, but at the same time, it does represent both in terms of profit share and market cap share a large percentage of our markets, right? So, you know, a small company growing at 30%
is okay.
So let's take a specific example. I mean, let's take Unilever versus, let's say, Honasa Consumer, right? I mean, if Unilever or Nestle, or maybe particularly Unilever, growing at just 7 or 8%, and Honasa growing at 30%, can we make a fair statement that Indian consumer market is growing at 30%? The answer is no.
No.
Right, because the larger companies do represent a larger percentage of the pie. Some of the younger, smaller companies are growing better because they are more innovative. I mean, they're innovating at a much faster pace as compared to larger companies. And they're probably taking some market share away as well.
And the base is smaller.
Base is smaller, of course, but they're taking market share away. That's. I mean, if you go back in the history in India, it's unusual for small mid-cap earnings to grow at 2x the pace or 2.5x the pace of large caps.
Exactly.
Especially when there is a bit of a slowdown. it happens in a raging bull market, right? So what we used to think in India that small and mid are basically a leveraged play on larger caps or the leveraged play on the economy. So when the large cap companies' earnings growth accelerate, then you get a second derivative impact on the mid and small, and vice versa. So whenever large companies' earnings growth decelerated, smaller mid usually went into, forget slower earnings growth, but actually went into decline territory, which is why in most earnings slowdown environment in India, large cap stocks tend to do better. I mean, think about 2015 to 20. It was HDFC Bank and Kotak Bank doing exceedingly well at the expense of almost all other banks. Today is vice versa, right? HDFC is not moving, ICICI is not moving. Karur Vysya is at a life high, Federal is almost at a life high, and stuff like that. So
have things changed then? Because even from an FI-DI perspective, if you're seeing, it seems that the DIIs and you have the SIP, that's the retail investors who are probably coming in and they're somewhere rescuing our markets to some extent. FIs are absolutely not there. For how long will this community be able to keep our markets this resilient is the question, because investments are still happening.
So, you know, the SIP flows or the incremental flows which are happening, they are also chasing performance to some extent. So it's not that they're going into mega caps, they're actually going into more mid, small.
Actually.
And some thematics as well. So at this point of time, I mean, returns are not as exciting as what they were, let's say, 2 years ago, or what the expectations were, but it's there. It's there for the taking. So even this year, I mean, YTD in Nifty is on, what, 8-9%, give or take. But there are enough number of stocks which are 30, 40, 50% up. When I was just looking at BSE 500 top ranked returns, Hitachi Energy, which is Power India, is up 100% in 4 months, in 4 or 5 months, right? So the Indian investors also chasing the pockets of growth. So long as that is there is still interest.
Is there a worry though, looking at, and we were looking at the monthly figures for the indices, right? The mid cap index and the small cap index, small gains. But if you put it above April gains, right? What we were at the end of March, where the argument could definitely be made that we were relatively not expensive. We can't make that argument very strongly for the broader markets anymore.
You can't. I mean, India has always been a bit of an expensive market. But despite that, we have attracted flows. Despite that, we have done generally well because of high quality nature of our generally companies, right? So, I mean, what we used to say that the way India differentiates itself with most of the emerging markets is we are a high ROE, high FCF components in our market. Now, conversely, to some extent, our strengths have now become our weaknesses. So because of the high ROE, high FCF focus, we have not invested in R&D, new technology and new businesses.
We're not doing the new exciting stuff.
We're not doing the new exciting stuff because it will put your balance sheet under stress. So, I mean, while the whole AI chip industry is looking very exciting, let's not forget that US has not seen this kind of a capex since World War II, since the post-industrialization period. And much of this capex is coming in through borrowings and through private credit, which is a little bit of a worry. But it reminds me of the 2003 to 7 cycle in India. So high capex-led growth tends to generate animal spirits, right? And there is animal spirits that we are seeing in the whole semiconductor industry. This cycle, India is missing.
We're sitting on the sidelines.
We don't have a representation to the hot sectors of the market. So, and this time we're feeling the pain a lot more. So in the last 30 years that I've been in the market, every time a cycle turns, we have something to offer, right? So 90s, let's say late 90s was dot-com cycle, we had software companies. 2003 to 7 was hot commodities and infrastructure. We had our commodity companies and infrastructure companies, right? 2015 to 20, there was a little bit of a quality bias right across the world. We had a high quality FMCG and high quality banks. This cycle is AI and tech, and we have nothing to offer.
So when you see, for example, and that's a big statement and a correct one. When you see, for example, an emphasis trying to level up, a Wipro expanding its plan, some of even the mid-cap companies, trying to do what they can do. Is it giving you some kind of comfort that they will eventually catch up, or you feel like it's a bit late?
No, I think we will eventually catch up. So, when we are discussing the markets here and now versus India's outlook over 5 and 10 years, there are two different discussions.
Fair enough.
Right? So, like in many other things, like in telecom and mobile telephony, right? India was a very late starter. US was a far earlier starter, but we leapfrogged. Leapfrogged to an extent that Indian mobile technology actually became better than the US for a long period of time, till the time US caught up in the recent past. So, we will certainly adapt and adopt AI, maybe not as a producer of AI, but as an enabler. And as an enabler, we will use this to enhance our productivity. We will use it to add more economic value. But it'll take time.
And maybe we'll be the guys who allow an Uber to use it properly. We were just talking about this where, Uber's figuring out, is it worth what we're doing? We've blown through our yearly budget in just 4 months. You need someone to come and also direct the flow of what AI is going to bring to the table.
Of course. So I think we will get there. But we also can't leapfrog it today.
No, but there's also the point of what you were mentioning, right? Which is the kind of spending that is currently taking place in the US and the fact that Indian companies are focused on ROE and FCF. That profligacy, if someone were to say, I'm going to spend so much on AI adoption today, no investor is going to be okay with that.
Absolutely.
So therefore, I think slow and steady might actually be a good thing.
I mean, so many discussions which happen India versus China, right? I mean, China grew for a few years at like 13-14% GDP growth, then collapsed all the way down to 3-4. Markets boomed for 10 years, collapsed for 12-13 years after that before starting to come back only 2 years ago. Now, one can say that 1990, China and India were very similar. All the metrics were similar. GDP was similar. GDP per capita was where they are today and where we are now. But one can always say that 6% GDP growth, sustainable over 50 years, is a better quality way to grow, right? But then one should not also complain when you miss few exciting phases when everybody else is doing better than us.
No, but tell me one thing. For a country like India, a lot of times we have been followers. I think majority of the times, right? And sometimes we do look at the ancillary plays as well. Say, for example, you're talking about AI, you're talking about semiconductors. Yes, we're not at the forefront, but you have ancillary plays which are at play. So you talk about power, you talk about cap goods. And these are the sectors which have seen good amount of value creation that has happened right now. Do you think these pockets are the ones which will continue till the time we play that catch up on the main AI front and could be good investment bets? I mean, that's what people are looking at right now then.
I mean, as a business, 100%. As stocks, one should also look at valuations. Right, so there are two different things. The huge electricity demand or power demand which AI is creating around the world, will a lot of India companies participate in there through exports of equipment, T&D equipment, transformers? Will the business grow at 30, 40, 50% per annum for the next few years? Of course, I mean, it's a given. With the kind of investments which are happening, there are trillions of dollars, right? They're no longer billions of dollars anymore. But from the current valuations, will the stock make money or not? I think that's a different question. So I'm not a believer of buy at any price. Markets went towards that towards the end of the last decade, and they're paying a huge
INA.
There is no alternative in BAP stocks. Buy at any price. The BAP stocks. So, it's backfired for many. Just one last point. We are at an inflection point as a nation, right? As we try and catch up, and then we realize that when push comes to shove, we better have our own house in order. You can't depend on anyone, really. They could be friends today, not tomorrow. The kind of policy push that we're already beginning to see, and we will see over the next few years, where we need to become self-sufficient. We need to figure out our rare earth, our semiconductor, our chips, our APIs for pharmaceuticals. Is there a real opportunity there, or you would wait and watch and see if we can actually accomplish all of these things?
No, we are very late in few of these, right? So semiconductors, we are very, very late. Will we do something there? Of course. So the few plants which are coming up at this point of time in terms of the quality and sophistication of the entire semiconductor food chain, we're right at the bottom.
Yeah.
We're not, I mean, we'll take, I don't know, 20 years to catch up with TSMC, if at all we catch up.
Because the tech is changing very rapidly.
It's very rapidly, and we're starting, I mean, I don't remember the exact nanometers, sizes, etc., but all I know is we are at least 5 generations behind.
Yeah, for sure.
If not more. So, your question had 2 parts. One is self-reliance. I think the whole globalization theme that we saw working in the world for about 20, 30 years is reversing.
It's over.
Right? So, from multilateral, we are becoming bilateral. From one common regulation, one common sort of platform driving multiple countries, businesses, and growth is now becoming one-on-one discussions. I think on that we are doing really well. So our government is really engaging one-on-one with each individual trading or business partner and managing to strike fairly decent business relationships. So the recent visit to whole of Europe, I think it was a resounding success. All across. So we are doing fairly well there. Second is self-reliance in terms of, is it possible for any country to make everything it needs?
No.
I don't think so.
Yeah.
Right? So self-reliance does not necessarily mean we will be able to produce NVIDIA level of chips here or TSMC level of chips here. Or
no, but we don't need to. We need to just make sure that we are not caught out in the cold.
Correct. Yeah. So it's available to us.
So energy, for example. Big lesson, right? So $95, $100 crude. We're going to need to do something quickly.
Personally, energy is a big disappointment for me.
Yeah.
Because in 1990, the crude imports was 3% of our GDP. In 2026, it's also 3% of our GDP. Now, that's one place where successive governments have not paid enough attention.
Yeah.
And the reason why we haven't paid enough attention is that when crude goes to 120, 110, 130, we start saying we need energy security, we should buy oil assets, we should do investing, etc. And then
it dissipates.
Crude being a commodity, it comes down back to 60, 70, and we say, it's okay, it's fine. Now, what we also forget is the currency angle.
Yeah.
So crude at 100 today is lower than crude of 130 of 2007. But crude of 130 at 2007 translated into 7,000 rupees a barrel, crude price for India. Today it's 10,000 rupees a barrel because our currency is depreciated, right? So the hit on us is not just the crude price, but also crude price multiplied by currency depreciation. So we need to do something about energy security. And hopefully this time we will not forget the next. I mean, once the war gets over, things settle down, crude is back to 70.
We can't wait. We can't wait for the next crisis to blow in. Dheeraj, absolutely fabulous to have you here. We're going to have to wrap up, but tell us what you think of the show, what you want us to discuss, and of course we'll be back here same time, same place next week. Thank you for watching.
Thank you so much.
I hope
good fun.
You enjoyed the format.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Niraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates into clear perspective. Down the stories shaping the world. From markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit.
And the award goes to
Tamanna Inamdar, Managing Editor, NDTV Profit.
Leading the newsroom, shaping the narrative. From stories to impact, a voice that matters. Tamanna Inamdar, among India's most influential, power, purpose and perspective recognized. NDTV Profit's editorial force gets industry-wide acclaim.
Indian equity benchmarks record sharp fall in the last 30 minutes of trade today. Both Sensex and Nifty end over 1.5% lower. Barring IT index, all other sectors decline. Meanwhile, rupee strengthened 70 paise against the dollar. Oil falls nearly 2% on reports of potential US-Iran ceasefire deal, with Brent crude hovering around $92 a barrel. But tensions remain as nuclear program still remains the sticking point between the US and Iran. RBI's latest annual report flags rising risks from West Asia conflict, warns that geopolitical tensions could impact India's growth, inflation and banking system. Meanwhile, the RBI's balance sheet expanded 21% year-on-year to 92 lakh crore rupees in FY26. India is headed for a below normal monsoon season this year. IMD revises rainfall estimates downwards to 90% from the earlier estimate of 92%. India-US trade deal is in the final phase. US Ambassador to India, Sergio Gore, says expect to finalize the trade deal in the next few months as the US delegation is coming for talks next week. Swiggy says working constructively with the shareholders after proposal to transition into an Indian-owned and controlled company, or IOCC, fails to secure shareholder approval. The resolution received 72.6% of the votes, falling short of the 75% threshold required. Rising input costs puts pressure on Colgate as it hikes 4 to 5% price across select toothpaste packs. Increases seen in key SKUs like dental cream and Visible White. Despite a scorching summer and relentless heat wave, AC companies are seeing weaker than expected sales this season. Sales are up 10 to 15% versus the estimate of 25 to 30%. As Siddaramaiah exits DK Shivakumar to be the next chief minister, Siddaramaiah and son would meet the party high command in national capital. All eyes on the Congress legislature party meet scheduled for 4 p.m. Saturday. Hello and welcome. This Friday afternoon, you have joined us on Profit 360. I'm Nisha Poddar. Let's take you through all the details of what all really made it to the news today. First, starting with the equity markets. Well, the markets ended on a weak note, with Nifty really recording over a 300-point sharp fall in the last leg of the trading session. Both the Sensex as well as Nifty settled with cuts of over 1.5% each. One of the key reasons behind the selling pressure could also be the MSCI adjustment, which likely triggered portfolio reshuffling by the global investors. Add to this a weaker monsoon forecast by the IMD and FII selling. Now, the buying confidence clearly took us backseat today. My colleague Puneet is right here with a detailed roundup of the market action through the day and the week. Puneet, tell us.
Well, thank you for that. Just as you rightly mentioned, the last half an hour or so, we've seen that MSCI rebalancing happening, and hence that impact that you've seen on the markets, a very sharp drop in the Sensex as well as for the Nifty 50, as you mentioned. Now, while the larger Nifty IT companies, the likes of Mphasis and TCS, all tried their best in terms of giving that impact on the market for the positive sides, you had all the other factors continuing to put pressure on the index, and hence a day essentially to forget for the Nifty 50. We're back again around the 23,500 mark, and it hasn't been any kind of support at this point of time. So when you come back on Monday morning, you will look at things to get back to that support level of 23,800. But as you rightly mentioned, consistent pressure on the index. You have stocks like Indigo, which will come out with earnings today, also being under pressure, and Eicher Motors. They were the top losers in that index today for the Nifty 50. You also saw the broader markets also being under pressure today. So the mid-cap 150 companies that we saw was also down about 1% and third, and the small-cap 250 also continued to be under an impact. What I'll be watching out for, though, they were largely done with the earnings season now. So when you come back on Monday, there will be fresher factors to watch out for. Watch out for the geopolitical conversations that happened over the weekend between Israel, US, as well as Iran. And hopefully some more respite and some better performance to go through for the month of June compared to a volatile May that it has been.
All right. Thank you so much, Puneet, for getting us all those important details. Now to the money market as well. And the rupee strengthened sharply today as the global crude oil prices cooled off amid the reports of a possible ceasefire deal between the US and Iran. Now, the Indian currency, remember, closed nearly 0.7% stronger at 95 against the dollar compared to 95.7 in the previous session. Now, the move came after the oil prices fell more than 1% globally on hopes that easing tensions in the Middle East could really reduce the risks to the energy supplies. And remember that the crude oil prices have been below $100 per barrel now for the last few sessions. All right, moving on to another important development. The Reserve Bank of India's over 200-page annual report for FY26 has been released, and the Reserve Bank of India has flagged rising risks from the ongoing West Asia conflict, warning that geopolitical tensions could really impact India's growth story, inflation and banking system as well. In fact, my colleague Piyush joins us now to get us all the important key takeaways coming in that report and the highlights on the economy as well from the RBI. Piyush, tell us.
That's right. The top 5 takeaways are that the first one is that West Asia conflict actually could pose major challenges to India's economy. The RBI said that real GDP growth is projected at around 6.9% in FY27, lower than expected 7.5% in FY26. The RBI is saying that while the inflation could remain in its tolerance band of around 2 to 6%, but there are upside risks to the inflation because of this conflict that is happening in the West Asia region. Further, banks' loan portfolio may also get impacted because of this conflict. Now, the second key takeaway is that the RBI's balance sheet has grown around 21% year on year to 91.97 lakh crore rupees. Now, these balance sheet expansion was aided by the forex market intervention that the RBI did. Further, its investments in both domestic and foreign markets, and also its gold holdings. The RBI made around 1.69 lakh crore rupees gains in the forex market transactions, and it also moved around 1.9 lakh crore rupees towards of provision towards the contingency fund. Now, the third aspect that the RBI is saying is that the bond yields, global bond yields may rise further if central banks stall or reverse the current easing cycle. We have seen Indonesia hiking the repo rate, and the RBI said continued fiscal consolidation and durable liquidity will likely arrest some upward rise in this bond yield. The RBI said that the banks' loan rates fell by around 78 to 95 basis points in FY26 as against the 100 bips repo cut, whereas a bank deposit rate fell around 49 to 65 basis points in FY26. The RBI said it will continue to take forex market operations to arrest the fall in Indian rupee. Now, takeaway number 4, the RBI has taken a lot of enforcement actions against lenders in the last financial year. It has imposed a total of 241 penalties on lenders amounting to 26.33 crore. The penalties are of course for not complying with regulatory norm despite RBI repeating to address certain concerns. RBI, we are aware, last month also cancelled the license of Paytm Payment Bank. And the final 5th key takeaway is that the RBI is going to review all the cyber risks that emanate from new emerging AI tools. We are aware how Mythos has spooked all the regulators globally, including central bankers, government, policymakers, and bankers, of course. The RBI said it will further expand the use cases of CBDC and said that it will further scale up the unified lending platform. These are the top 5 takeaways from the RBI's annual report.
All right. Thank you so much, Piyush, for putting all that into perspective. And of course, it's a huge, report from which the key takeaways are given. But also geopolitical tension and its impact on the economy is something to make note of. But apart from that, what also impacted our Indian markets today was the monsoon forecast. Let's take you through that. In fact, India's monsoon outlook has turned more concerning now, with the IMD now revising its rainfall forecast lower to 90% of the long period average for the June to September season this year. And this is a further downgrade, remember, from the earlier estimate of 92% issued in the month of April. Now, the Weather Office has warned of a higher possibility of deficient rainfall across large parts of the country, something that could have a direct impact on kharif sowing, rural demand, and food inflation in the country. A weaker monsoon is certainly not an encouraging signal for the economy, and the situation will now be closely tracked in the months ahead. Listen into what the Ministry of Earth Sciences official had proclaimed about the monsoons.
Quantitatively, the southwest monsoon season rainfall over the country as a whole is likely to be 90% of the long period average. 90%. Actually, you remember earlier we have told 92. Now it has been reduced to 90. But the category wise, it is also become below normal category. So it is below normal rainfall is most likely over the country as a whole. That's what we are expecting as of now. And you all know that in the May, we always give these homogeneous region wise how it will be the monsoon. Because April forecast, we don't give anything related to homogeneous, but now we come out with the homogeneous, but the uncertainty will be high. That's why instead of 5 range, we give only 3 range in that. So in the southwest monsoon seasonal, rainfall is most likely to be normal over Northeast India, it is roughly about 94 to 106% of long period average.
All right, so lower than estimated low monsoon this time, and that is becoming a worry even for the market momentum and the economy. And even as the monsoon outlook turns weaker after an intense summer, there's an interesting trend really emerging from the consumer durable space. Despite a scorching heat wave across large parts of the country, well, air conditioner companies are now staring at lower than expected sales this season. So what's really dragging the demand despite the extreme weather, and what are companies really saying about the outlook ahead? Sesa Sen, my colleague, is right here with all the details. Sesa.
Right, India may be witnessing one of its harshest summers, with temperatures soaring close to 50 degrees Celsius across parts of North and Central India. But the extreme heat is not translating into the air conditioner boom that companies had anticipated. Major players including Voltas, Blue Star, Daikin as well as Godrej are reporting sales growth of only 15 to 20% compared to last year. And this is far below industry industry expectations of 25 to 30%. Companies say that, while part of this growth is coming off a weak base, if we compare it to the blockbuster 2024, the growth remains as low as 10 to 15%. Now, companies say that demand in the mass segment particularly remains under pressure due to higher AC prices as well as subdued consumer sentiment. Manufacturers have already taken price hikes of 8 to 10% this year in order to offset the increasing raw material costs. At the same time, higher fuel prices, which is up nearly 7 rupees and 50 paise per litre, along with rising household expenses, are weighing heavily on consumer spending. Dealers had, stocked up adequately ahead of the summer season, expecting strong demand after last year's sales were disrupted by unseasonal rainfall and fluctuating temperatures. But inflation appears to have quickly dampened those expectations.
All right. Thank you so much, Sesa, for getting us those details. Of course, we are in the thick of earnings season as well. And aviation company Interglobe Aviation has come out with its results. And it's noteworthy that their net loss of 2,536 crore rupees is higher than what the street was expecting by a slight bit. And also, when we take a look at the other internals and numbers, well, the revenue is also a slight miss, only a marginal miss at 22,438 crore rupees. The company has already stated that they have got a one-time loss of 250 crore rupees. They have also stated that their forex loss is to the tune of over 4,000 crore rupees. It is an important set of numbers amidst the global crisis when it comes to the fuel costs as well as also the connectivity that is becoming a problem. So Interglobe Aviation definitely, navigating the situation of higher ATF prices and also the forex losses that they have now accounted for in their results. So those are the numbers. Incurred forex loss of 4,823 crore rupees. Of course, come Monday, these numbers would be reacted to. But another set of Nifty 50 companies that really came out with its earnings today is Asian Paints, which reported a strong set of fourth quarter numbers. You'll remember that there were several price hikes that have been taken. Now, profit rising nearly 70% on a YOY basis to 1,172 crore rupees. Margins also improved significantly, with the EBITDA margin coming in at 19.3%. The company's decorative business remained a key growth driver. And my colleague Sharad is right here with the quick analysis of Asian Paints number. Sharad, tell us.
Well, largely Asian Paints came out with a good set of numbers. There was a beat in both revenue, PAT and EBITDA. And interestingly, the volume growth also, if you look at it, that came in at 10.2% in terms of volume. And remember, that's the higher range which was expected between 8 to 10%. It was already factored in that there was a higher other income aiding the PAT numbers, but the street is definitely concerned on what will happen in the first quarter. Will there be more price hikes or that margin hit which might be taken? And that's where a little bit of concern comes for the future. Overall, looking at the numbers, the industrial coating numbers are also decent, a double-digit growth coming in. And this is primarily two reasons. One is, of course, the inventory build-up in fourth quarter and the price hikes taken, aiding the overall top-line numbers. But the management commentary was cautiously optimistic. Amit Single, the managing director and CEO of the company, stated two important points. First is that the external environment remains fluid, especially the Western Asian conflict, because there is a near-term uncertainty. And secondly, the strong fundamentals and execution might support the domestic business going ahead as well. So, of course, this is a cautiously optimistic tone coming in from the management.
Right, cautiously optimistic there. Asian Paints numbers stronger than expected. Thanks, Sharad, for that. Now on to the war situation. The US-Iran conflict is escalating sharply with strong rhetoric as well as military signaling from both the sides. US President Donald Trump has claimed that America holds all the cards. Meanwhile, tensions have really intensified in and around the strategically crucial Strait of Hormuz. And according to Wall Street Journal, a proposed 30-day de-escalation window is currently on the table. The draft framework reportedly calls for for an end to ship harassment activities in and around the Strait of Hormuz, while discussions are also underway on a possible mine clearance mechanism in the region. What did the US Treasury Secretary Scott Bessent really say about the nuclear program in Iran that has been the sticking point? Listen in.
This administration, President Trump, has done something that no other administration is able to do. We have gotten the Iranians to talk about their nuclear program and to perhaps commit to not having one. That has never happened before. It had been off the table. So I think when you look at the results of the kinetic action of our economic pressure, it has worked to bring them to the table and have a discussion on this.
All right, Scott Bessent there. An India-US trade deal that also gains momentum. US Ambassador Sergio Gore has said that the US delegation is coming for trade talks next week and expect that trade deal will be finalized in the next few weeks and months. Listen in.
We're looking at individuals that frankly are trusted, and India is one of those partners. Today I want to share with you what we've achieved in just over a year, because trust isn't just a framework, it's delivering real results. Let's first talk about artificial intelligence. Let me start with that. The first pillar of trust, and it's an ambitious undertaking that will shape the future of the world. We committed to developing a US-India AI infrastructure roadmap, identifying constraints to financing, to building, powering, connecting large-scale US origin AI infrastructure here in India. Since then, the Department of Commerce has taken measures to restore the flow of advanced AI chips to our partners around the world.
All right, let's take it to an important corporate development coming in from the new age startup space. Swiggy's plan to transition into an Indian-owned and controlled company, which is IOCC, has really failed to secure the required shareholders' approval. The proposal, which was aimed at strengthening control and also improving the margins through an inventory-led model, has run into a governance hurdle. Following this particular development, Swiggy said it is working constructively with all its shareholders to address their concerns and take the process forward. It's an important development for the Swiggy shareholders to track. All right, let's take it straight to the world of politics and resignation and transition done. All eyes are now on the new Karnataka Sarkar. In fact, DK Shivakumar and Siddaramaiah are in the capital today. They have met the High Command. Both have had separate meetings with Mallikarjun Kharge. Siddu, along with his son, also held an hour-long meet with Rahul as well as Sonia Gandhi at Sonia Gandhi's residence after the power parleys over cabinet formation and next deputy chief minister. Both Siddu and DKS had lunch together. Siddaramaiah is now headed back to Bengaluru. A crucial CLP meeting will be held tomorrow at 4 p.m. in Bengaluru. The meeting will be chaired by Siddaramaiah, DKS, and also Surjewala. To attend the meeting, this is where DKS will be declared the chief minister, is what the reports suggest. All right, so those were the important headlines and news developments. With that, it's a wrap on this edition of Profit 360, but do keep it with NDTV Profit through the day for all the news, views and development. Thank you so much.
I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Niraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
You have a plan which you know has a lot of pain ahead in it as well. And it's a tough business.
13 years ago now, and we were wondering what to do with our lives next. A little bit of an aha moment we had was we were seeing local food being reimagined in the countries we were in, and we were like, nothing like this is happening in India.
I started working when I was 20 at a hotel not too far away from here as a waiter in a restaurant. So it was maybe like 2 a.m. in the morning. It was a coffee shop, and it was just two guests, slightly drunk. They had ordered French fries, and I kept the bowl on, and the top one was slightly burnt at one side. And he pointed at that and he said it's burnt. And I was like, sorry sir, I'll get it changed. And my hand had just gone down to like pick up the bowl. He got up and he moved his arm like really close to my face. He didn't hit me. And he closed my face and he said, if I slap you right now and I say sorry, isn't that fine as well?
Oh, wow. Because through the journey, how you start off with Bombay Canteen, quickly becomes known also because of the celebrity chef aspect.
Everyone knew Chef Floyd as a celebrity chef because he had been on Top Chef Masters, had won it. For us, Floyd was more like a father figure, a mentor.
We were also very conscious of the fact that we can't do this on our own. Neither of us cook. At the core of it is the food.
Your favorite dishes?
Yesterday I was craving the pastrami sandwich from Veronica. So
we call it the Kaju Katli Indie Bite.
India's unshakable news habit. NDTV.com is India's #1 English news website. When the headlines move fast, perspective matters. On Editor's Cut, our editor
क्या सर्च इंजन के चक्कर में पड़े हो दोनों? अब कोई कंफ्यूजन नहीं. कॉल 9300 300 300.
Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. This is the KYC show where I get you important companies, what's their growth trajectory looking like, and is there any alpha to be made or not. Let's start with one company today, very interesting company, but before that, try to guess it or try to guess it. That's one hint as well. It's a global staffing solutions company. Let's move ahead. The restructuring was done in 2025, largely in the June month. So it's pretty much interesting. Stock, interestingly, is up 26% from March lows as well. And the company operationally has come out with a decent set of numbers. But which is this company? That's more important to understand, and I'm sure you must have guessed it by now. The company is Quess Corp. This is the company which we are going to talk about. But why are we calling this company? Is there a new strategy at play? Is there something called Quess Corp 2.0? We'll try to understand this plan, and going ahead, which areas should the company be focusing on? Interesting. Let's see the second question. Is the gig economy versus non-gig economy? How are the solutions looking like when it comes to the staffings? Also, the expected demand from this staffing solution industry from the government itself. That'll be pretty much interesting. There are some needs which the company wants to ask the government. The skilled talent exports, how big this market is there any niche work at play? And also, the FY27 revenue and margin outlook as well. Professional versus general staffing, where is the growth momentum looking like? Is there an up move coming in from the BFSI segment? And of course, 71% of their key businesses come from the GCC segment as well, and the overseas expansion. Are they going very heavy on new markets such as Singapore? And to understand the entire picture, we'll be joined in by Lohit Bhatia. He's the CEO at Quess Corp. So Lohit will make us understand where does the company and the industry stand. But what does the company actually do? Let's try to understand, and what are the key services they are offering right now. That's pretty much interesting. There is, of course, professional solution and general staffing solution. It was established in the year 2007 in Bengaluru. Also, important category is India's #1 staffing organization. This is by head count and 4th largest globally by the same definition. So interesting take. And the head count is roughly 4,80,000 and they are having 30 plus offices as well. This is how they're expanding, and almost 2,200 clients with over 30% more than 5 years tenure. That's where the stickiness comes in. Footprint is there across 8 countries. I had mentioned you regarding the operational front, and 26% market share they're having. If you see the flexi workforce headcount, that's also an important area where there is a good momentum happening. General staffing, roughly 281 new contracts were added in 2026. And also, if you look at the operating EBITDA, how things work out for general staffing, it is roughly 50% of the business still come here. Remember, India as a whole is still a human capital market, and this company is a catalyst for it. That's an important point. Also, 30% of this EBITDA breakup comes from the professional staffing, and the remaining 20% comes from the overseas business. So these are the 3 categories. But for key FY26 takeaways, the professional staffing, the total headcount for the GCC segment I was talking about is 71%. This is why this is important, because the way the GCC explosion is happening in India, that is where the momentum is coming in. Overseas business, 125 new logos with a double-digit growth in revenue and EBITDA. So of course, there is a good surprise happening, and India's growth model is being applied to other nations as well. But how the industry is there? The India staffing and recruitment industry, there's a CAGR of almost 13% expectations is there. Look at 2022, it was a $19 billion market, and expectations by 2030 is almost that $50 billion mark. But the new dividend policy is something which is pretty much interesting for a stock like this. It will return almost 75% of the free cash flow to the shareholders. That's an important takeaway, and with this will come via interim, final or share buyback cumulatively over the next 3 years. So there is definitely, apart from growth, there's a dividend policy as well. But what's working for the company, that's pretty much important to understand. So there is a new ventures in Quest Corp 2.0. We'll try to understand that from the management, and Lohit will explain us that. Is the beneficiary of GCC explosion. That's an important take as well. Also, the third important point is the valuations are cheaper compared to global peers. 16-17 ke PE pe aa raha hai ye company. Strong affiliations in international businesses, and that is how they make these tie-ups with a global organization such as ILO, the International Labour Organization as we call it, and of course the new dividend policy. So that's pretty much interesting. तो ये तो मैंने आपको पूरी कंपनी की कहानी बता दी, लेकिन KYC का कहानी क्या है? That's important as well. And to start KYC's कहानी, we are having the ratings where we judge the company. Of course, we have got the income statement, balance sheet, cash flow, and of course return ratio to show how things have progressed, especially after the demerger which took place in the middle of 2025. So our numbers will be a bit different to compare them with. Shareholding, street cred will also be there. Valuations, we will compare them with their peer, that is Team Lee Services, to understand whether the stock is cheap or not. And of course the analyst take, are they bullish on this counter? If yes, what's the return potential? So a lot of questions, but I'll get you all the answers. Let's start with the first one, income statement. चौथे तिमाही के number largely operationally ठीक थे, and if you look at how things have gone up, it's been a pretty steady mover. It hasn't been a very huge mover. Remember, there is a big base also for a company size like this, and a decent returns has come in, and a good up move in the PAT, at least for 222 crore rupees. कभी labor code revision impact आता है, कभी change in business model आता है. And overall, if you look at the numbers, the top line was kind of a degrowth, but the magic is there in the bottom line numbers. Sequentially 16% up, and also you can see 7.5% up, especially for EBITDA, PAT respectively. And of course, looking at the margin profile also, this seems quite decent, but this is how the business rolls. So let's give it a neutral rating right now. But let's move on to the balance sheet, and balance sheet is something which I like because it's well capitalized. I have removed the difficult portions for you, for these two are important to actually track. Cash bank balance is pretty strong, और जब ऐसे कंपनीज के आप बात करते हैं तो इनकी बायबैक होती है, इनकी डिविडेंड दी जाती है, because they are cash heavy businesses. Will they acquire more international companies or not? That's also one question to be asked with Lohit. But as of now, it is well capitalized, so it's a strong thumbs up when it comes to the balance sheet. Let's talk about the cash flows and see what happens. And largely, most of the cash flows business is, you could say, a decent kind of payment schedules which are there, operating cash flows. However, in FY26, there is a slight dip coming in, and even the net cash flows also, there is a downtick. Remember, there has been an impact of the restructuring as well, and because of that, these numbers are coming. Largely, इसको हम comparable नहीं रखते, तो एक benefit of doubt देते हैं हमारी rating के लिए, और इसको neutral rating देंगे. Let's talk about return ratios and see what has happened. And we have taken, of course, the last 3 years, the ROC numbers and the ROE numbers. Remember, these are adjusted numbers coming in, and now company has been demerged. There was an important restructuring as well. In FY24, both of them between 12 to 15%, but then there's a gradual up move coming in, and it is sustaining. Look at this ROC number for FY26. This is at 31%. And around 20% ROE. So this is definitely a very positive sign for the investors. So I'm going to give this a strong thumbs up when it comes to the return ratios. Now let's look at the shareholding, what has happened. Largely promoters की बात करें तो उनकी stake में कोई changes आई नहीं है. FIs, there is a little bit of concern in my analysis. It was around 14% and that has come down to 8%. So there has been a 6% sell-off. But on the other hand, to negate it, DIs have been lapping up right from, you could say, around 10%. That has actually gone up and it's around that 12% mark. So this kind of nullifies or averages things out. So it's even Stevens when it comes to the institutional holding. And for that, I'll be giving this a neutral rating as well. But of course, let's talk about the street cred also, how much the stock has actually made money. Of course, we are not going to get last 5 years data because company ka demerger hua hai. So whatever is the nearest, numbers to look at, that's where we'll focus on. This is where the demerger had happened. From June onwards, the things started changing. From March lows, if you're a trader, you have made money everywhere. So this stock is also there. So the interest is back in the stock. And for a trader, you have made money, congratulations. But this year itself, stock has been flattish. And the last 6 months, stock is down 8% as well. So it's still a neutral rating. We need to give it more time to understand this trend, whether this becomes a multi-bagger or not. But remember, of course, there's a dividend adjustment and everything at play. Let's look at the valuations, what's happening here. Quest Corp is currently trading at a 12-month forward PE of 12.5 times. Compare that with Team Lease, it's at 15 times. मतलब कंपटीटर से चीपर है, बट अपने 5-year एवरेज पी से उतना सस्ता नहीं है. इट्स एट 11 times and this is at around 12.5 times. So on its average basis, the way it trades, it's still on the higher side. But look at Team Lease, that's more expensive as well. So historically, it is expensive, but compared with peer, it is definitely cheap. So I have kept it neutral and given this a neutral rating when it comes to the valuations. But apart from valuations, let's talk about the analyst. Analyst community क्या कहती है? Totally 9 analysts are tracking the stock. There's not a single sell rating for this stock, but majority of them, around 87.5% of the analysts have a buy rating. Remaining 12.5% are having, you could say, a hold rating. But target price कितना? ये important है. Analysts जो बताते हैं 12 महीने का target price is 277 rupees per share. That means from the current levels, 30% of return potential is expected. So overall, analysts are giving a strong thumbs up when it comes to Quest Corp. So let's try to understand, last time the company had come in KYC in September 2025, we had given them 3.5. Let's see, has the company changed? And moreover, we see the balance sheet has strengthened and the return ratios post the restructuring has improved a lot. So there is a good point over here. Cash flows, income statement giving a neutral view. While on the other hand, shareholding, street cred and valuations, I have given this a neutral view, but the analyst take is quite bullish on it. So is there an inflection point for the company? Is there a chance of re-rating? Those are the key questions coming to my mind. And overall, the KYC rating, let's put it out, is 5.5 out of it. So definitely there has been an increase from 3.5 to 5.5. So largely in line with the numbers which we give in a KYC and slightly positive for a company in this space. But to understand more and answer all our queries, we'll be joined by Lohit Bhatia. He is the CEO of Quest Corp, and of course, he actually handles all the 3 segments as well, and 25 years of multi-industry experience is what Lohit has. An interesting snippet about him, he joined this company in 2011 as just a sales general manager for staffing, and then he has gone up to this group level CEO and scaled this associate base from 13,000 to almost 4,80,000 in his tenure. Good afternoon, Lohit. It's always a pleasure to have you at NDTV Profit. Of course, the earnings were there a couple of weeks ago, but I would like to start with this new initiative, which is Quest Corp 2.0. What this is all about? Where is the focus all about?
So, thank you, Sharath. Good afternoon. It's always great to be on your show at NDTV Profit. And I hope everybody is safe and well. If you really look at it, this is our 19th year of doing business. In the 19 years, proud to say that not only are we India's number one at 480,000 employees, we're also Asia's number one and fourth largest in the world as far as volume of talent and workforce management that we deploy. Our revenue stream as of now, as you would have already told your viewers, is over 15,300 crores for the year. This year, we've been able to deliver consistent growth when it comes to our margin profile from 1.8, inching upwards towards 2.2% at our exit. We are a net cash company with about 270 odd crores plus. This is the 6th year consecutively that we've announced dividend for our shareholders. 5 rupees and 5 rupees already given as interim, and a final dividend, 5 rupees and 3 rupees as interim and interim special, and another 3 rupees that we've given for our shareholders to approve at the ensuing AGM, overall giving 11 rupees. This is also, it's going to be heartening to all the shareholders of Quest that in the last 6 years, Quest has returned 830 crores of cash back to its shareholders just by the forms of distribution of dividend consistently for these 6 years. So when you have a platform like this, which I've just elaborated and explained in 19 years, what is it that we want to do in future, given India's benefit both from a demographic dividend point of view and India's strategic position in the global order? What we want to do is we want to continue doubling down on our volume strategy and value strategy within our existing Quests, which is where our general staffing business will continue to expand and grow. Our professional staffing business will add margin profile on top of it. And then will come the international staffing, which we are also enhancing. But under Quest 2.0, we are feeling that there will be a new wave, a resurgence of what can be created besides what we already see and besides what our shareholders already know of as Quest. In this, we are looking at a couple of new corridors. And for us, corridors would be Far East, corridors would be the Nordics, corridors would be Canada and US, and corridors would be Israel and UK. Second, what are we looking at within those corridors? We're looking at segments. What could be the segments? One of the segments that we feel, again, looking at the global order of, aging population, demographic dividend, and citizens' requirement of support in healthcare, aged care, technology workforce, construction and MEP workforce. As you know, India is signing FTA agreements one after the other with multiple countries. And in every FTA, there is an embedded clause of talent mobility. And India is becoming a preferred destination for enhanced talent mobility from India to the rest of the world. So under our Quest 2.0, this is one significant area that we want to look at. The second significant...
Yeah, go ahead, Lohit. What's the second one? Yeah.
The second significant area is that if you really look at it today, Quest provides you talent as permanent employees. It provides you talent as temporary staff. We provide apprentices and in some shape and form consultants as well. The fifth form of work, which has started proliferating in our lives every day, is the gig workforce. And we feel under Quest 2.0, gig is the additional form of livelihood and employment that we also want to participate in. It's still early stage. It's on the drawing board, and I'm sure very soon we'll be able to tell you more about that as well.
Pretty much interesting. And we discussed about the gig economy as well. It's a pretty interesting take and a big industry. But the expected demand for the staffing solutions, there is some request coming in from your industry to the government. Is there anything, Lohit, you want to, ask or, say to the government through our mode?
So thank you for that question. And I think that's a very, very important structural question for India. Sharad, if you really look at it, 500 million Indians even today go and have informal work. Informal work is where you don't get a contract, you don't get an appointment letter, you don't get social security, you don't get skilling, and you don't get enhanced benefits over the course of your livelihood. Our industry, the staffing and the livelihood industry, is taxed at 18% under the GST because we were put in the services category, rightly so by the government because we are a services part of the economy. However, as the government came out with a massive revamp of GST 2.0, a lot of products have been pushed towards the 0 or the 5% GST rating, whereas very few have been kept in the higher than 5% category. This unfortunately has created an anomaly for the workforce management industry or the staffing industry as labor suppliers and services to the rest of the economy. Our request to the government of India is that under services, if there is any segment that requires a relook at GST regime, maybe from an 18% to a much lower 5%, you will see unlocking of value and many Indians moving from informal labor market to formal labor market. And this will be beneficial because this will increase your formal financial inclusion. It will bring more money in the banking system. More insurance offtake will happen. You will have more PF, ESIC coverages. There will be less vulnerability in society. And I think overall as a nation, we will be more proud about the kind of workforce that we have in this country.
Right. So we discussed 2.0. We discussed what are the expectations or demand from the industry. But I just want to understand your company specific, any kind of outlook, guidance for revenue and margins, what's looking like for FY27, FY28?
So we don't give an immediate guidance, Sharad, but we have made our next 3 or 4 year plan, which has also been elaborated to the board, and all our business leaders have made a next 48-month plan for themselves. Under this plan, we are looking at a steady state, watch towards both enhancing our volume part of the business as well as the value part of the business. Under volume, we are looking at a headcount growth upwards of 10% per year, which should yield about 45 to 50,000 workforce and more. Second, we are looking at enhancing our entire value realization. And with that, we feel that the revenue trend would be close to about 13% to 15% range. And that will yield to an 18 to 20% bottom line or profit pool growth for us consistently. This will also be aided by a change in mix and going towards a higher margin businesses. As you know today, general staffing, which is the lower margin business, but yet better than the nearest competitors, we have 50% of our profit pool coming from general staffing. The balance 50% comes from higher margin businesses like international at 6.5% EBITDA and the domestic IT and professional staffing business at above 12% EBITDA margins. So if that's what I can call it as a plan, but not so much as a guidance.
This is a 4-year plan coming in from Lohit. But Lohit, let's try to understand the GCC segment. India is having its moment. The GCC explosion all around. We can see larger players coming, Mumbai, Hyderabad, Bangalore, you name it. And also your overseas expansion. I need your commentary on both of these important topics.
So India today has about 2,100 GCCs already. If you really track these GCCs, they have come 65% have come only from the Americas in the last 30 years. And many of them are part of the Fortune 1000 or Fortune 2000 companies. Our hypothesis is that in the coming period, it will be Generation 1 companies, primarily from the Nordics, primarily from Far East, primarily from your Middle Eastern region. These will be companies which are Generation 1 companies between the $1 to $15 billion. And the kind of solutions that they need is in the range of $50 to $150 million. They would be coming to India, one, because of the quality of the talent and the scale of talent that India can provide. Second, they're obviously coming for enhanced infrastructure, which is getting created in the country. Quess, along with 2 of its other listed peers now, group companies, 3 of us, 80% of the work can be done by Quess Corp itself, which is related to the talent part. The balance 20% with our other group companies which are also listed or other general market operators will be able to provide a plethora of services for build, operate, transfer as far as the GCC is concerned. And these GCCs will again somewhere dovetail back from those 5 corridors that I spoke about, which is part of our Quest 2.0 journey.
Right, Lohit, that's pretty interesting take coming in, but we understood and more clarity has come in for the market, especially after the restructuring has come in, and this is the way to actually treat Quest Corp. Lohit, it's always a pleasure to have you at NDTV Profit, and best of luck for the future and your 4-year to almost 10-year plans as well. So that's the management of Quest Corp. Actually, especially coming in after the restructuring and giving out their 2.0 plans, and we are the first channel to get that, interestingly. And let's see whether this momentum continues or not and their ambitions are met or not. That's the question, but only time will say that. But for those interesting stories like this, stay tuned to NDTV Profit, and yes, keep watching KYC.
Have a plan which you know has a lot of pain ahead in it as well, and it's a tough business.
13 years ago now, and we were wondering what to do with our lives next. A little bit of an aha moment we had was we were seeing local food being reimagined in the countries we were in, and we were like, nothing like this is happening in India.
I started working when I was 20 at a hotel not too far away from here as a waiter in a restaurant. So it was maybe like 2 a.m. in the morning. It was a coffee shop, and it was just 2 guests, slightly drunk. They'd ordered French fries, and I kept the bowl on, and the top one was slightly burnt at one side. And he pointed at that and he said it's burnt. And I was like, sorry sir, I'll get it changed. And my hand had just gone down to like pick up the bowl. He got up and he moved his arm like really close to my face. He didn't hit me. And he closed my face and he said, if I slap you right now and I say sorry, isn't that fine as well?
Oh, wow. Because through the journey, how you start off with Bombay Canteen, quickly becomes known also because of the celebrity chef aspect.
Everyone knew Chef Floyd as a celebrity chef because he had been on Top Chef Masters and won it. For us, Floyd was more like a father figure, a mentor.
We were also very conscious of the fact that we can't do this on our own. Neither of us cook. At the core of it is the food.
Your favorite dishes?
Yesterday I was craving the pastrami sandwich from Veronica. So
we call it the Kaju Katli Indie Bite.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Niraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
India's unshakable news habit. NDTV.com is India's #1 English news website. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut. Every Friday, 3:30 p.m. Only on NDTV Profit.
And the award goes to
Tamanna Inamdar, Managing Editor, NDTV Profit.
Leading the newsroom. Shaping the narrative. From stories to impact. A voice that matters. Tamanna Inamdar, among India's most influential, power, purpose and perspective recognized. NDTV Profit's editorial force gets industry-wide acclaim. He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market open, now in its boldest lineup.
It's been a painful couple of years for India's equity markets, and there's no denying it. There are so many reasons that have been propounded, from a lack of AI to a lack of earnings growth, and then the latest and justified derating because of the sensitivity to crude oil prices amidst the war in Iran. I must confess, though, that at no point over the last 10 years have I heard so much negativity about the SIP as a method of investing. For example, one particularly negative comment that I read on social media was, generations to come will scarcely believe that SIP enthusiasts did some pretty dumb investing, unquote. I'm curious about what my guest today has to say about that and the longer-term prospects of the Indian equity market. Vinay Paharia, Chief Investment Officer of PGIM India Mutual Fund, joining me on MoneyWise today. Thanks so much for taking the time, Vinay. Let me start with that. Because I've spoken in previous episodes about dollar cost averaging, and in effect that is what the SIP is, and investing in India. But this negativity that is going around social media, and I know that you spend very little time on social media, but let me tell you, there is a lot of negativity. What do you make of it?
Sure. Thanks, Alex, for having me on the show. So I think the negativity is also an outcome of expectations. And what we have seen is that in the last 5 years, most of the investments came in Indian equity markets, and the SIPs increased in the Indian equity markets post the pandemic period, which is 2020. And from 2020 till about 2024, we saw a one-way market. And that changed the expectations. So people started expecting that every time we put in money in SIP, we'll make money. But that's not the nature of the beast. And equity markets are doing exactly what they should be doing, which is surprise people on the short period of time. So I think most of this negativity has to do with very, very near-term performance, which has been lower. And remember, that is also following a period of very, very strong performance. So I think this is the nature of the beast. This is the nature of markets, and there's nothing new in this. And hence, most people should go back to the drawing board, know that equity has this in its nature to keep fluctuating in the short term. In the medium to long term period, it does exactly what it is supposed to do, which is follow underlying earnings. And underlying earnings have been very strong. And in fact, Indian economy is actually growing at 2x the pace compared to the global average.
I do want to talk about some of those aspects, sir. I know that you're a student of history as well, and you look at the way the markets have performed, obviously cycles and all of that. But I guess the reason why this particular phase of Indian equity markets is getting people's goat is that it has been the longest period of consolidation in at least over the last decade, right? There have been periods of underperformance, but the COVID-19 period was a jhatka. It fell very quickly, it came back very quickly as well. So most investors got into the fold after 2019 have experienced that very rapid increase, and so they've not gone through a prolonged downturn. Is that the reason why there's so much uncertainty and negativity?
Oh, absolutely. In fact, I would say this is the safest and the least damaging effect of the market, because historically when equity markets have corrected, the corrections have been brutal, and it has led to people losing a lot of money, which means there was a brutal price correction. This time what we have seen is more of a time correction. The markets have gone sideways, not delivered you as much returns as you would have thought, but not given you any brutal correction. And I think this is a very good outcome for most people, because we have seen almost 80-85% of new people enter into the markets fold post 2020, and they are seeing this phase of time correction for the first time. And I would say this is a very good thing to happen to them. At least their expectations start correcting and they start moderating, so that the expectations start coming very closer to what the potential for the asset class is to deliver.
On the argument that SIP investors have provided an exit for foreign institutions at various points over the last 1.5 years, what do you make of that? Because the argument is that there is this flood of money that comes through every month, 30,000 crore rupees at this stage, and that provides the perfect exit for those who want to exit at decent levels. Does that make any sense?
So I think what people are doing is reasoning, but that's maybe not necessarily the approach to look at it. The foreign investors also bought from someone.
Yeah.
So now they are also selling to someone. And someday they will also buy from someone. So I think it's not correct to think of it like this. And the only approach to think of it is that maybe investors who have come in 2024 paid a higher valuation, for which they have to pay some tuition fees. And I think this 2 years is their tuition fees, a very nominal tuition fees in my approach.
But I don't understand what the argument here is, because in a sense, somebody has gone so far as to say that if you don't invest at this stage and if you let the equity markets fall, which effectively is the thesis, right? SIP investors don't come through, so that flood of money is not available to buy when FIs are selling, so the prices will drop. That is the thesis. Allowed to fall 30% and FIs will stop selling. I don't understand. Markets don't work this easily, right? Absolutely. Or am I missing something?
Absolutely. It is very naive to think like this. Markets don't work like this. If you are offered an asset which is worth 100 at, let's say, 80 rupees, anyone will come and rush to buy it. Remember, money is like water. It always flows towards spaces which are empty. It always flows towards spaces which offer better returns. So if hypothetically the situation like what you have said comes in, there will be more and more money chasing it, and money will ultimately normalize returns and bring it down to levels which are much more palatable.
Okay, let's talk about how you're viewing the current situation, right? And I usually, in the recent weeks, have been issuing a safe harbor to say that this is a show that is recorded earlier in the week. It plays out on a Friday and things can change. I'm actually hopeful that the war does get over by the time this plays out. But having said that, how do you view the long-term prospects of India, particularly because at this stage, the degree of underperformance to an MSCI is so stark. Of course, there is the argument that there is sensitivity to crude oil prices, but is this kind of underperformance justified, Vinay?
Once again, Alex, it is exactly the things which we just discussed, which is markets have underperformed because they had outperformed materially.
Sure.
So what we are doing is comparing from 2024 period where we were screaming at the top of the house, highlighting that markets have borrowed returns from the future. So now some of these returns are getting pushed into the future, and there's nothing wrong with it. That's the way the market works. So I think Indian markets meaningfully outperformed the MSCI emerging markets from the period 2020 till 2024. And this underperformance post 2024 is just a period of normalization. I think lots of things have been written about how India was the most expensive market in 2024, and markets like Korea, Taiwan, Japan, and China were significantly more cheaper and offered much superior growth prospects. So I think money exited India and went into some of those markets, and now once again India started becoming much more attractive. So,
can you explain how you approach your portfolio building and what your thesis is? It's quality and growth at a reasonable price. So, how does this work, and how does your framework work when you're building a portfolio?
Sure. So, it will take me a little bit while to explain it to you. So, we have done a big study on what has worked in Indian markets over the last 2 or more decades. And what we have observed, and this is purely a fundamental study, so what we observed is that there are 2 material variables, which is first is companies which exhibit higher than average quality or returns on equity, and companies which exhibit higher than average revenue growth. So companies which exhibit both these characteristics together have a much higher probability of outperforming the market compared to everything else. And the data tells us that 8 out of 10 years, a diversified portfolio of such companies have delivered significantly superior returns compared to the market. So for us, this is the universe. We create a universe of all companies which are high quality and high growth, and then create portfolios out of this universe. So there are 2 engines which are working at the same point of time. The first engine is high quality, high growth universe. Historically, there is a scientific evidence now behind it that it has worked. 8 out of 10 years, it has outperformed. So we are picking stocks from this universe. And what are we picking stocks based on? We are picking stocks based on 3 things. What is the forward earnings growth? What is the forward quality? And most importantly, what is the forward price to fair value discount? It is not a plain vanilla P multiple.
Why do you say that? Because I read this as well, and we've spoken in the past as well. People tend to look at the index level, and they look at stocks, and they look at trailing PE, they look at 1-year forward PE, and they say, hey, this is either cheap or expensive. You think that that's too simplistic? Why?
Absolutely. So think of it like this, Alex. There is a company which produces, let's say, 25% return on equity. Let's say you start with 100 rupee equity. Every year it is capable of producing 25 rupees. And there's another company, it takes the same 100 rupees and it produces 10 rupees on that. So one has a 25% ROEs, another one has 10% ROE. For the same growth and for same prospects, which company do you think you will be paying a higher price to acquire? You will be always obviously be paying a much higher price for the 25% ROE company. There is simple financial metric for that, which is what is the value of a annuity growing at even 0 till perpetuity. That's annuity divided by cost of capital. And for a growing annuity, it is annuity divided by cost of capital minus growth. And this growth is influenced by returns on equity. So I think there is a very clear financial metric, very intuitive financial metric, which influences the decision on P multiple. So in fact, what we have done is we have created a framework which helps us compute the fair multiple which each company should trade at. And this metric is actually driven by 4 factors. what is the forward earnings growth, what is the forward returns on equity, what is the risk-free rate in the economy, and finally, what is the riskiness of the business. Most underappreciated part is the fourth part, which is what is the riskiness of a business.
How do you judge that?
Once again, it has got statistical measures for judging that, for quantifying that, and importantly, we have back-tested it, which means, I'll give you an example.
Yes.
Take an example of an FMCG company and compare it with an airline.
Okay.
Right? Let's say both of these companies are able to generate the same return on equity. Now think of it like this. If you have, let's say, lot of capital with you and you can buy one company, which one do you think you'll buy?
I would pick the FMCG
company. Very simply.
And just to complete that analogy, and I'm assuming this is the reason why you're saying that, is that 45% of the cost of the airline company is sensitive to crude oil, which is a significant amount of risk. And so in a scenario where crude oil prices go up substantially, the ability to pass on in ticket prices is not as significant, whereas an FMCG company can do so on an ongoing basis, particularly if it is a leader in the space.
Absolutely. It's like a toll road. So I gave you very extreme examples to simplify the concept. Everything lies somewhere in between. But the crux of the matter is that all other factors remaining constant, a business which has a lower risk will always command a higher valuation compared to a business which carries a higher risk. It's a very underappreciated aspect of valuation. All of these four factors which we just talked about come together, act together to create something what we call as the fair value multiple. So when you apply this fair value multiple to the core earnings or core book value of companies, you come and you can compute what could be the potential fair value at which these companies can trade at, compare them to the current prices, and you get a potential upside based on which you get valuation upsides and downsides.
Now that we have discovered how Vinay Paharia thinks about his portfolio methodology, let's talk about the current scenario and how you see it. When you look through those lenses that you've created, that matrix that you've created, and you look at the opportunity as they stand right now, you said that in several scenarios, the underlying earnings growth is looking relatively robust. And this, I must say, Vinay, is at a time when a lot of people are derating their earnings expectations for FY27, which is the current financial year, based on the damage that is being done as we speak right now, which is in the first quarter. Obviously, with crude oil prices on an average above $100 to the barrel, has had a bearing in Q1. What is your expectation based on what you're seeing?
Great, and I think I did expect this question simply because there is always too much emphasis on what is happening now.
Okay.
And our job as investors is to look through what is happening now and look at the lens of what is going to happen over the next 5 years, 10 years,
okay. So
20
you're looking
years.
that far out.
Absolutely. I'll give you an example for that and why the near term can magnify some of the issues significantly out of proportion. So imagine, right, the current narrative is that oil prices are high. The leadership itself talks about being frugal. So there is a challenge, right? But very importantly, think of it like this. What happened during the first week of pandemic?
There was chaos.
There was chaos. The leadership announced that please don't leave your houses. Shut down the factories. There was lockdown. Nothing can be more disastrous than that.
Yeah.
But was that perpetual or was that transient? So the most important thing which you as an equity investor should judge is, are the current events transient or they have a material long-term impact?
Okay.
If anything has a material long-term impact, please feel free to build it in.
Okay.
What we think is the current stream of events are absolutely transient. It is like acute illnesses. You fall sick, but it is transient.
Which of these are you defining as transient? I would buy that the West Asia crisis and the energy crisis that is stemmed from that, the supply chain issues, all of those are transient, just like the supply chain issues that emerged from COVID-19 and that supply shock were transient. It took a little while, but it resolved itself. And in fact, some of the supply chain changes that took place in COVID-19 are now changing. That just-in-time approach is not working anymore. Anyway, but the point is that there are few narratives that have been created that may not be transient. What about the AI story? What about the fact that when you're talking about India, India's IT sector, which has been the darling of the street for so long, is now facing an existential challenge according to some people. And so the conversation, Vinay, has moved from a PE story and a no growth story to a what is it? They were talking about a culmination value. What is the value that you're talking
terminal
about?
Value.
Terminal value. There, terminal value. So they're talking about the narrative has shifted so dramatically for Indian IT. So which of those narratives are you saying is?
So I'm in the camp which you talked about. I'm those people who are talking about the terminal value getting impacted. Okay. And you are absolutely right. Bang on. Artificial intelligence is a meaningful disruptor. It could be a meaningful disruptor not just for the tech sector, but for many, many sectors, many segments of the market, which today we are unable to appreciate. So you are absolutely bang on in highlighting the fact that artificial intelligence can create meaningful challenges, but at the same point of time, there could be a lot of opportunities which could come from it. At this point of time, we are at loss to identify many of them, but it is absolutely correct that this is going to create a huge challenge for at least some of the sectors which we can see right now. Indian IT sector is one of them. And I think we have been meaningfully underweight this sector for the last 1 year exactly because of this reason. But it is going to impact a lot more sectors.
Okay, so therefore, and here's the thing, obviously the reason why you're professional money managers is because you can look that far out. If you look at the opportunities that this entire situation has maybe thrown up, and you've also pointed out that GDP growth in India is significantly higher than the average, okay? My question to you is, what according to you is the long-term earnings growth that you're penciling in for the portfolio of stocks that you have selected in your framework?
Sure. So generally, when we talk about companies which are high quality and high growth, these are companies which are naturally able to grow at a faster pace.
Yes.
And for this growth, they are able to fund themselves through their own recurring internal cash flows. So these companies historically have grown somewhere in the range of 200 to 300 bips higher than the overall universe. So let's say India's GDP growth is at 6%.
Sure.
We can add about 4%, and I'm talking about longer term,
inflation.
5 years, 10 years time frame. We add 4% inflation, which is the central bank's target.
And nominal GDP.
So that's the nominal GDP. Corporate India is growing at a slightly faster pace than the nominal GDP because of the benefits of GST, and we all talked about it at length. So let's say the corporate India grows at about 11%. Our companies are expected to grow at least 300 to 400 bips higher than that pace.
Okay. Well, so you've spoken about how IT is underweight for you and for obvious reasons. What else do you not like and what do you like? What are the themes that you think, and when you look at your universe of stocks and you see the biggest opportunities, and I obviously know that it's not going to be a sectoral bent, it's going to be a bottom-up approach to stock picking. Having said that, what are the sectors and what are the ideas that you think will work heading into the next 4 to 5 years?
Sure. So one of the themes and sectors which we have been very positive on is the healthcare services sector. This is a sector which is underpenetrated. It is growing fast, has retail-like characteristics, which means hospitals keep adding new beds, and these do get utilized fairly quickly, which means there is a meaningful demand for quality and organized healthcare. And this is showing up in the numbers for most companies.
Yeah.
And we are now having a large bouquet of organized chains which are listed. So this is and there are a lot of other ancillary healthcare services companies also which are part of this. So this is a sector
Diagnostics as well.
Yeah. This is a sector which we think has legs to go. It has a long-term visibility, and I think these are spaces which we can invest in for a long period of time. Then there is the telecom sector. This is a sector which has slowed down in perception of most people, but we think this is a sector which could be a silent beneficiary of the artificial intelligence boom which is happening. Because think of it, who owns the pipes to the entire population of India?
Yeah, that's fair.
These guys are having the pipe. You can put in anything in this pipe, and they're monetizing it.
But you don't worry about the argument that every so often there is a significant amount of capex that will have to come through and that they'll have to spend on, and usually it's not only going to come through internal accruals, though some of the large players are generating a significant amount of cash.
Absolutely. So that was one of the biggest challenges. Till the time we had not seen the full rollouts. So now the telecom rollout is almost complete, and now most of the telcos just need to add few more bells and whistles to the stars, and the towers then are 5G enabled or enabled with the latest technology. So I think the quantum of capex which might be needed in future might be much smaller than what we think. And importantly, very importantly, these companies now have scale. They now are able to reach the entire population, and importantly, they are also able to monetize. So tomorrow, if they are going to offer you better services, they will be able to charge you also for those services. And importantly, this entire market has very limited players.
Yeah, interesting. So you've healthcare, telecom, anything else?
Yeah, so there are other parts of consumer discretionary which we like. There are new age consumer discretionary firms like in quick commerce. There could be new age e-commerce companies. Importantly, we are not looking at all the new age companies from a same lens. What we think is that it's important to understand that many of these companies possess some very important financial characteristic. One is they are able to grow at a very fast pace.
Yeah.
Importantly, some of them have got very high gross margins and fixed cost structure, which means that with high growth, you get a meaningful operating leverage. And third important characteristic is that they require very limited dose of capital. So their capital turn is very high. So the companies which we are looking at should have all of these three characteristics together. And of course, based on our computations of the fair values which we just discussed a while back, they should be available at reasonable valuations. Some of them are available and satisfy all of these criteria, which is why we are bullish on many of them. And these are meaningfully large businesses, not small. So these are areas which we think are going to capture the India growth story going forward. And a lot of that value should come to us as shareholders.
Rapid fire to end. I'm going to try and ask you, because I've not planned for this, but I'm going to try and ask. Are you optimistic or pessimistic over the next 3 years in India?
Very optimistic.
Do you anticipate short-term volatility, particularly in the current scenario, for the next 1 year?
Yes.
Moderate return expectations that were suggested at the start of last year, do they stay the same this year?
Anybody's guess.
And which is the best market in the world to invest with regard to equity?
India.
On that note, Vinay, thanks so much for taking the time.
Thank you very much.
You have a plan which you know has a lot of pain ahead in it as well, and it's a tough business.
13 years ago now, and we were wondering what to do with our lives next. A little bit of an aha moment we had was we were seeing local food being reimagined in the countries we were in, and we were like, nothing like this is happening in India.
I started working when I was 20 at a hotel not too far away from here as a waiter in a restaurant. So it was maybe like 2 a.m. in the morning. It was a coffee shop, and it was just two guests, slightly drunk. They'd ordered French fries, and I kept the bowl on, and the top one was slightly burnt at one side. And he pointed at that and he said it's burnt. And I was like, sorry sir, I'll get it changed. And my hand had just gone down to like pick up the bowl. He got up and he moved his arm like really close to my face. He didn't hit me. And he closed my face and he said, if I slap you right now and I say sorry, isn't that fine as well?
Oh, wow. Because through the journey, how you start off with Bombay Canteen, quickly becomes known also because of the celebrity chef aspect.
Everyone knew Chef Floyd as a celebrity chef because he had been on Top Chef Masters, had won it. For us, Floyd was more like a father figure, a mentor.
We were also very conscious of the fact that we can't do this on our own. Neither of us cook. At the core of it is the food.
Your favorite dishes?
Yesterday I was craving the pastrami sandwich from Veronica's. So
Me, we call it the Kaju Katli Indie Bite.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Niraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
India's unshakable news habit. NDTV.com is India's #1 English news website. When the headline
Strong Q4 revenue momentum, one-time bad debt impact, but an upward revision of the FY27 constant currency revenue growth guidance to 12.5% from 10%, a new enterprise AI platform launch, aggressive AI team scaling plan. There is so much to talk to Joseph Anantharaju, co-chairman and CEO, and Venkatraman Narayanan, managing director of Happiest Minds. Gentlemen, thanks so much for joining in, both of you. And I can say, I mean, it's a decent quarter, but it's the outlook ahead that interests me more. So I'm going to start off with that, Joseph. FY27 growth guidance and pipeline visibility. That's my first point, because you've recently upgraded, I believe, your FY27 constant currency guidance to 12.5%, citing accelerating AI-first momentum. What is that the driver behind this upgrade, or large deal conversions, GenAI pipeline, or other factors?
It's a mixture, actually, of reasons, and several reasons that have gone into it. Underlying all of that was a very detailed revenue plan exercise that we conducted in March, that was at individual customer level, and with each IG or BU and the respective sales team taking responsibility. And we stress tested it again just a couple of weeks back before presenting it to the board. So we're 2 months into the quarter, so Q1, Q2, you have a decent visibility. So that was what gave us the confidence. But if you look at the drivers, as you rightly pointed out, the pipeline is looking very healthy. There was a 27% increase year on year, quarter on quarter in pipeline. And what is equally heartening is that there are several large deals cutting across multiple quarters and years in the pipeline. So this gives us a little bit more of stability and cushion when making a forecast like this. But I think what is really driving a lot of the customer traction, as you rightly pointed out, is the AI-first strategy. We're seeing some of the customer POCs and smaller projects that we used to do getting converted into larger implementations. We have, a couple of $1 million AI implementations going on, with a few in the pipeline that are of equal size. We're also seeing quite a bit of demand from customers to use AI, and some of it is proactive, where we've been going and evangelizing to customers, where you can use AI in their SDLC or in their infrastructure and security to get a higher level of productivity and therefore accelerate your roadmaps and reduce your spend and do more, basically. And I think there are, some of the strategies we had put in place last year around P, large account, GCC, having some SAP experience that's related to AI. All of these, we've got people on board to execute on them, and they will start contributing revenues this year. So that's what gives us, these are the drivers that gave us the confidence to give the 12.5% and aspirational 15% guidance.
In fact, Venkat, that was going to be my next question. Actually, part one is how much revenue visibility do you already have for FY27, and what would it take to move towards that aspirational 15%?
See, we don't give the typical numbers of TCV and ACV that other companies talk about, but we give relevant guidances like repeat sales happen to be about 92% of our revenues. So that's one. Second is, 52% or 50% plus of our revenues come from customers who have been with us for more than 5 years. We also now have started sharing our pipeline and strength of pipeline. So it's all of these put together, which we communicate the kind of revenue uptick that we have. And this has been traditionally the case because we have taken a view that giving a number which really doesn't get followed up through on subsequent calls or on quarters doesn't make too much of sense. So that's one. As far as our pipeline is concerned, it's I should say the best it has been in many quarters. We are getting into FY27 on a strong footing. Just to give you a perspective, every quarter from our IPO, we have grown sequentially. Yes, there have been muted quarters and high quarters, but we have managed to keep that trend going along. And given the way we have ended the year, and we are looking at the pipeline, the signups, and the absorption of AI first and AI capabilities that we are taking to market, it's giving us a real, confidence that this 12.5% with a possible upside of 2.5% is possible.
Okay. Venkat, you guys announced this enterprise AI platform. And I've seen a lot of companies in the last 5-6 days do that, right? Wipro apparently has done that. Emphasis we know has done that. Tata Elxsi, if I'm not wrong, has done that too. So what's happening here? And for you in particular, how does this impact?
So it's a good thing. It's we are not standing out or we are not outstanding. At one point, largely you should see this as one of the many things that we are doing. So we have got Ellipse for security, Elara for customer support. We have got Eduvi for education, Rel AI build for our internal SDLC, rebuilding solutions, Artha banking. We are infusing quite a bit of AI. And we are creating multiple agentic platforms, agentic capabilities across multiple IGs or industry groups that we have spoken about many times over. So this is, it's a progress. Essentially, the sign that we are giving